also in the rates market based on what's priced in. I don't think in the UK we have felt the maximum impact of past monetary policy tightening. So I think there is a clear possibility that BOV could actually deliver more easing than the market is currently pricing.
So here's the latest this morning. The Bank of England rate decision due at the top of the hour. Jeremy Stretch of CIBC writing, quote, "We would be unsurprised should the bank look to prepare the ground for a June adjustment. We expect a 25 basis point cut at the next meeting and assume 75 basis points of easing in total this year." Jeremy joins us now for more. So Jeremy, let's get into that. We've heard from the S&B.
Good morning, John.
We've heard from the Riksbank. Cut. Are we going to see the same thing from the BOE and the ECB later this summer?
Yes, I think that's highly probable. I think we would expect both of those central banks to be very much biased towards monetary policy easing over the course of the summer. So we're looking for both the ECB and the Bank of England to start their policy adjustments in June. The Bank of England, well, clearly the inflationary dynamics have yet to come into place in terms of reaching the target. But when we get the next CPI release, I think it will be pretty close to that 2% target threshold. But I think the important point today is not only the vote composition, because watch out for Mr. Ramsden's vote, but it's also going to be the inflation profile that the bank produces. Now, we know the bank have had a little bit of pressure on their forecasting strategy and methodology from the Bernanke review, but nevertheless, I think we will focus on that inflation profile, and if that's revised down, then I think that will open or prepare the ground for a policy easing at the June meeting.
Let's breathe some life into that. The inflation profile, how different is it in the United Kingdom compared to what we experience here in America?
Well, I think there are certainly some similarities. Clearly, the UK continues to witness significant degrees of service sector inflation. So that, I think, is one of the factors that we are continuing to monitor. And of course, the labour market is also continuing to generate or register reasonably elevated degrees of wage growth. But I think we are starting to see some signs that discretionary spending is still under some degree of pressure. We will expect that to be further compromised as we see mortgage resets continue to work through the system. So I think we can and should see some degree of moderation in terms of activity. And of course, I think the Eurozone and the UK are probably in similar circumstances regarding the macro and or inflation profiles. And perhaps that's the delineation with Europe relative to the US. The macro story is much weaker than we're currently seeing in the US. And that's the reason why the Fed is going to be somewhat more reticent to adjust the policy, although even there we still expect the Fed to be starting to cut rates by September.
Well, of course, Jeremy, no central bank wants to go at it alone. Of course, they will if the data says that they need to. But is the ECB going in June? Is that a huge opening right now for the BOE just there in front of them to tailgate off the back of their cut?
Well, I think there is certainly some communication that will obviously be ongoing between the various central banks. We've seen already a couple of central banks ignoring or moving well ahead of the Fed in terms of the Riksbank this week and, of course, the SNB. I think in the context of the Bank of England, they will look to adjust policy without reference to what the Fed is doing. Clearly, there will be some policy implications in relation to the valuation of sterling relative to the dollar. So it may well be the case that we do see a slightly cheaper value of sterling as a consequence of that earlier policy adjustment if we're right in June. But I think the bank will be very much focusing on the domestic data, and that is going to be the important factor here. So I think in the context of today, the Bank of England governor will no doubt try and maintain maximum optionality in terms of the policy outcome, but ultimately the data, I think, will, allied to the forecast profile, warrant policy easing as at the next meeting in June.
Well, Jeremy, let me bring another American corollary in, because many folks have said, okay, the Fed, they can't move when it comes to November because of the election. In the UK, we're expecting an election. Rishi Sunak has said it would happen in the second half of this year. It needs to happen by at least January of 2025. Does that impact the BOE's timing?
No, I don't think it does. I mean, clearly, monetary policy doesn't operate in a vacuum, but in the context of the Bank of England, they are very much judged by their economic thresholds and, of course, that inflation profile. So I think, yes, there will be some external influences on the bank's thinking, particularly if there were to be another fiscal event being announced by the government before the calling of the election. Now, it doesn't look as though the public finances will warrant that, but certainly there had been previously speculation there could have been another fiscal easing in an early autumn budget. but I don't think the political timetable in itself is going to cause a significant degree of consternation from the Bank of England. They will be looking purely at their macro dynamics, and then that will warrant whether the timing is appropriate as early as June for policy easing.
I think a lot of people would agree with you, Jeremy, and that would apply to the Federal Reserve as well, which is why so many people are looking to September. We saw that from Sarah House of Wells Fargo. September, first cut from the Federal Reserve. Where it changes, the wrinkle I think it introduces, Jeremy, is 2025. I really struggle to find any clear outlook whatsoever on 2025 without knowing or understanding the outcome of November.
Yes, that's absolutely true, because clearly if we were to have Mr. Trump back in the White House, the risk is that if we were to see a reacceleration in trade frictions and the associated price pressures that would bring, then that would clearly have an important dynamic, or underline an important dynamic regarding Fed thinking. So in a sense, that is the difficulty that we all face as market participants in terms of trying to anticipate the policy outlook for the Fed in terms of 2025, because we have to make judgments, or at least assessments, as terms of the underlying inflationary dynamics. But ultimately, as it stands, we are still expecting a graduated easing in policy through the course of 2025. We should see yield curve steepen as we do see the Fed reacting to a slower growth trajectory and or a moderation in inflationary pressures by some toleration of easier policy. So we're expecting, obviously, as they say, two cuts this year from the Fed starting in September. Yeah. But obviously the outlook for 25 is going to be contingent on the political outcomes.
Do you think the Federal Reserve dictates how far the others can go? And I'm thinking more specifically of the European Central Bank. If they don't go for a long time, does that dictate and shape how far the ECB can go beyond, say, a June cut?
Well, I think June is effectively a given, and certainly that's the way the market is priced. I think if the Fed were to be on hold for longer, now, as I say, that's not our base case view, but if the Fed were to be on hold for longer, then there would be a risk that if the ECB were to be seen to be much more activist, and the Bank of England would be in the same boat, perhaps, then that would potentially have some implications via the currency transmission channel in terms of inflationary dynamics. So there is an element of sort of constriction in terms of how far both the ECB and the Bank of England can move ahead and beyond the Fed dynamic. As I say, we're assuming 50 basis points of easing from the Fed this year, and that is not inconsistent with expecting a little bit more from the ECB and the Bank of England, where we expect 75 basis points of easing from both.
Jeremy, what sort of difference in timing would it take for us to start talking about euro parity again?
I think if we were starting to see the Fed very much off the agenda through the context of the rest of this year, so I think that would be certainly something that would be necessary, I think, and we probably need to see the ECB announcing a rate cut in June, but also leaving open, if not a pre-commitment, but certainly a clear bias towards significant policy easing in the second half of the year if the inflationary dynamics are proving to be well behaved. So I think that's the sort of narrative we would need to see, a significant degree of sort of divergence in terms of rate expectations vis-a-vis where we're currently priced in order to facilitate certainly a move down through that 105, 103 area. And of course, once you were to get down to those sort of levels, then parity thresholds would start to come back into vogue, or at least into discussion.
107.35. Jeremy, thank you, sir. Jeremy Stretch there of CIBC on the euro just at the end. I want to bring up David Malpass, the former World Bank president, who wrote this in a Wall Street Journal recently. He'll be speaking to Anne-Marie in about 35 minutes' time. January 1st, the suspension of the debt limit expires. This year's spending bills will likely be extended just long enough to kick the can to 25. Tax rates will rise at the end of 25 unless Congress and the president can agree to extend some of the expiring provisions. 2025 is so difficult to get your hands around. If the former president gets a second term, you're staring down the barrel of massive tariffs too.
Yes, and it's not just that. Something many people have talked about, this idea that it also stymies the flows of immigrants. Immigration has been such a big topic, and why the economy looks as strong as it does, why the labor market is healthy, and why inflation is low. What happens when that's not the case anymore?
That conversation just around the corner. Here's the lineup for you in the next hour of Bloomberg Surveillance. We'll catch up with Sri Koshagovindan of Aberdeen. We'll speak to Eric Friedman of US Bank Asset Management, the former World Bank president David Malpass sitting down with Anne-Marie down in Washington, D.C. And we'll catch up with Bloomberg's Javier Blas on the commodity market. This time, apparently, it's coffee going crazy. A Bank of England decision is just about 4 minutes away. The equity market stateside on the S&P 500 negative by 0.2%. The second hour of Bloomberg Surveillance up next.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. exceptionalism, it's making its way through the U.S. stock market, and I think that can be somewhat sustainable.
There's been some wild swing at the stock and the sector level. Dispersion of stocks has been high in terms of performance.
We would like broadening out in the rally, but it is really not happening to the extent that we would like.
We're looking for a broadening effect. We have been for some time now.
We are cautious on both equities and on fixed income, and we're really waiting for better opportunities to add to both of those asset classes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. An absolute stacked lineup for you. Coming up on the program, Sri Kotchagovindan of Aberdeen on the Bank of England rate decision. Former World Bank President David Malpass on the, quote, perfect storm facing the next U.S. president. And Bloomberg's Javier Blas on what's behind the surge in commodity prices. The Bank of England leaving rates unchanged as expected. Danny Berger at 5.25.
And the split is important. We now have two MPC members who have voted for a cut. This is what we expected, that David Ramsden would join Swati Dhingra. This is the part that is important here because it shows an MPC where more movement is going towards a cut. You also have inflation. They see it at 1.9% in the second quarter of 2026. We've been pricing the BOE a lot like the Fed. We've been pricing a BOE who moves after July, who perhaps moves in August. Perhaps we need to rethink that now.
The guidance from the Bank of England, risks from inflation, persistence, are receding. From Governor Bailey, optimistic things are moving in the right direction. Guess where sterling is? Sterling off the back of this, weaker. The pound down to about 124.58 and negative a third of 1%. Out of the UK, in London, Bloomberg's Lizzie Burden breaking this decision down. Morning, Lizzie.
Good morning, John. Yeah, it's a dovish hold, this one. As expected, holding at 5.25%. Only 1% in markets saw a chance of a cut today. But as I say, the signal's dovish. Look at that vote split, 7-2. Dave Ramsden joining Swati Dhingra. He had made a speech that suggested he'd had a dovish tilt. And so there was speculation that he would join. If you look back through history, in November 2021, he voted to hike before the majority followed in December, and then in both February and September 2022 he voted for larger hikes, and then the rest subsequently followed. So the market will take this as a dovish signal. Perhaps you've seen the response in sterling there. It would be interesting at the press conference to hear if Andrew Bailey gives more of a signal like Christine Lagarde did about which data points they're watching for as to when to cut. Will that suggest that they go for June over August?
So if you are just tuning in, a rate decision 5.25, the Bank of England leaving rates unchanged, in line with estimates. The focus was always on the vote split over the Bank of England on the MPC. Out of the 9, 7 voted to keep rates on hold, 2 voted for a cut. That's an extra voice looking for a cut of 25 basis points. The guidance from the Bank of England, risks from inflation persistence are receding. Lizzie mentioned the Governor of the Bank of England, Mr. Bailey. Governor Bailey saying optimistic things are moving in the right direction. Lizzie, just to follow up, what needs to happen between now and next month to make that cut a reality? What's on the calendar?
Well, there are various bits of data that they're watching for. What would be so embarrassing, really, is if inflation gets to 2% and the Bank of England hasn't cut by August. You've got to remember that it's easier to explain these things when there's a press conference, and there's one today and there's one in August, but there isn't one in June. But so if they wait till August, there's going to be a lot of pressure, but it's going to be harder to get the comms right.
Lizzie, what sort of Bailey are we going to see today? We obviously heard from Hugh Pill, who is more in the latter camp of rates need to seem restricted. What have we heard from Bailey so far?
Well, he has also made the dovish signals. Finally, he's acknowledged that the Bank of England's situation is a bit more like the ECB's than the Federal Reserve's in terms of the inflation story. It took a long time for that acknowledgement to come, but it's this dovish signal in that you could read into it that the cuts are going to come sooner because inflation is coming down in a different path to the US here in the UK. I doubt that he's going to give us any sort of clarity on the scale of the Riksbank yesterday. I don't think he's going to be telling us, Danny, that 1 or 2 or X number of cuts are coming in 2024 from the BOE.
Hey, Lizzie, great to catch up. Lizzie Burden out of London. The Bank of England on the margin, dovish, sterling weaker, bit at the front end of the curve in gilts. Yields lower by 5 basis points on a UK 2-year. That yield right now is 4.24. Joining us on this decision, Sri Kochagovardhan of Aberdeen. Sri, let's get into this one and how it follows up the Riksbank, which Lizzie mentioned, over in Sweden, the S&B over in Switzerland. Is the Bank of England about to join them and cut interest rates next month?
I think there is a good chance now, given what we've seen in terms of the vote split, as you mentioned, but also I think the forecasts have been quite interesting. That downward revision across the inflation outlook is quite key. And also if you look at the undershoot from target, which I'm just looking at the summary now, I think that could be quite interesting, which is why we're seeing the price action now. So I think that there was a split between would it be June, would it be August? And I think now June becomes a bit more likely, obviously looking towards that press conference and the direction from there. I don't think they ever wanted to rule out June, but obviously it will be conditional upon data from here.
Well, let's get to the data and the outlook. So they see inflation at 1.9% in 2Q26, 1.6% in 2027. Sri, could you give me a better idea of what's driving that? Is that the demand side of the economy or the supply side?
I think it could be a combination of both. If we think more near term, there's very little adjustment there. And we are expecting a temporary dip below target over the next few months. And that's partly base effects from energy prices. Now, I think going forward, we're likely to see some of these pandemic-driven impacts on inflation. That's already starting to subside, but they're also looking more critically at that core underlying inflation and specifically at wage dynamics and the labor market. So I think there, the key drivers are likely to be focused around that labor market dynamic. And that's really something that they've been talking about materially over recent months.
Shri, the split of the vote, also important. It's something that I always find fascinating because it is a Fed who is so cohesive in their message, and it is a BOE, which is anything but. You have Ramsden now voting to cut now. We know Hugh Pill has talked about Table Mountains, choose whatever analogy you want, doesn't want to move. Bailey, more biased towards the cut. What does it mean to have such a divided MPC when we are nearing the start of a cutting cycle?
I think the vote split is an interesting messaging tool. And I think, if anything, it's less divided than before. Remember, there was a three-way split in the past. So this is clearly having a more dovish tilt. But obviously, we've heard more hawkish messaging from the likes, as you say, from Hugh Pill, from Haskell and Mann as well. But again, it's very conditional upon the data. And I think this overall split, and let's see what the forward guidance is from the press conference, but it does look like, we are past the worst in terms of that inflation dynamic. We are starting to see labor market conditions cooling a bit. And then really it's going to be that focus on wages, which is unfortunately above target consistent levels. But as we can see from the projections, they are signaling confidence that they can see wages cooling over time. Now, it could be the case that from the messaging that we see that the Bank of England doesn't actually have to wait for inflation to really prove that wages are cooling, that they can actually start the easing cycle. But remember, the messaging is also, even if they start cutting, rates will remain elevated for a meaningful period of time. So this is not going to be jumping into easy monetary policy. It's still very tight conditions and well above neutral rates.
Even so, Shri, Bailey has to get up there in front of the crowd at the press conference, speak to the markets just as much as he speaks to the journalists, and say perhaps some version of what you just said. But this is currently a BOE where it is the individual members who set the pace, who get the market reaction. It is not Bailey that is acting as the weatherman. Is this a credibility issue?
I don't believe it is a credibility issue. I think this is a technique that is very exclusive to the Bank of England, but it's also a very useful transparency technique as well. And I think this, the fact that there is, as I said, one direction, the split is starting to move more dovish. It's still the majority on hold. And you are correct. We need to look at not just what the governor says today, but also the individual speeches that will come after. Now that we're out of the blackout period, we'll start to hear more from those individual members. And I think what we really need to focus on is, as you say, the commentary from those more hawkish members. And I think the looking at the gilt price action now with yields falling, it's even though it's a 7-2 split, it does look like the markets have really interpreted this as a clear dovish signal.
That news conference starts in about 20 minutes' time. Looking across Europe right now, we've had a cut in the last 24 hours from the Swedish, the Riksbank. We've had a cut in the last few weeks from the Swiss National Bank, and now anticipating more, perhaps from the Bank of England as soon as next month, and maybe even the ECB as well. Shri, can we talk about what all that means for the Federal Reserve? And I'll share a quote with you from Andrew Hollenhorst over at Citi. This is what he said, quote, "The growing rate differential between the US and other countries is yet another marginal factor that would encourage the Fed to follow the global trend towards lower rates." How do you think this sets the scene internationally for the Federal Reserve?
Well, I would say that what we've seen recently over the last few months is a narrative that suggests that because the Fed are going to delay the start of the easing cycle, that will have spillover impacts on other central banks. Clearly, that is not the case. It does seem that each central bank is very focused on international drivers, but more specifically now on domestic drivers and domestic core underlying service sector drivers. So if you have confidence there, then you can start the process of easing. Now, with the Fed, obviously, it's at a different stage in terms of what's happening with the labor market and what's happening with wage growth. Now, we had a mix of data recently, payrolls data was a little bit more in Powell's favor, but that doesn't necessarily mean that they're going to be able to start easing soon. So we are expecting the first hike in September and possibly just 2 hikes, whereas previously, obviously, in the dots, they were signaling 3. And obviously, the markets have shifted along those lines as well. So I think the fact that other central banks have moved won't necessarily impact the Fed decision. The Fed are very focused on that domestic labor market dynamic, and I think that will continue to be the case.
When it comes to issues of your currency weakening, because that's obviously the main nugget of why you would be concerned of moving before the Fed, Jane Foley's been really good on this idea that for Europe, where growth is anemic, the concern isn't necessarily just the landing, but what it looks like after that landing, that they would welcome a weaker euro because of the growth it brings. Would you agree with that?
I think that's true, actually. You need to think about the long-term structural outlook as well. And I think there's less of a focus on that right now. Markets are very much, when is the date? Is it June? Is it August? And that seems to be the focus. But longer term, we need to think about the divergences across economies. And I think that's absolutely right. And I think when looking at that yield spread from Fed to other economies, euro area is one place that it has an impact, but obviously Japan, we've seen this week, there's been a huge focus on the yen, and as mentioned earlier on in this program, Governor Ueda has had to have meetings with Kishida, and potentially they will be forced to raise rates themselves a bit sooner than originally planned. There is a dilemma there between managing inflation and also managing the FX impact and how that has broader spillovers across corporates as well. So it's a very challenging backdrop as a result of this yield differential between the US and other countries, but each country has to deal with that in a very specific manner. So the euro area impact will be very different to, say, Japan or APAC in broader APAC economies. So that's something that leads to more divergence and opportunities for markets.
Really well framed. Shri, wonderful to hear from you. Shri Kutchagovernan there of Aberdeen. If you are just joining us, welcome to the programme. Just recapping a Bank of England rate decision, rates unchanged as expected at 5.25. A change to the vote, though, of the 9 officials on the Monetary Policy Committee, 7 voting to leave rates unchanged, 2 voting for a cut. That's an additional member of the MPC voting for a cut since the last meeting. The guidance is interesting. Risks from inflation persistence are receding. Optimistic things are moving in the right direction. More on that guidance in about 15 minutes' time, 16 minutes away, that news conference. For the price action, bid in the front end of the yield curve over in the UK. Gilts rally at the front end just a little bit, yields lower. And if you're looking at sterling, we are weaker on the pound by about 1/3 of 1% against the US dollar. That's the price action over in the UK. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Shanali Basak. Hey, Shanali.
John, shares of ARM falling in the pre-market. The chip design maker gave a lackluster revenue forecast for the year, raising concerns that the tech industry's AI spending spree may be slowing. 3 months ago, an upbeat forecast sent ARM shares soaring and helped the company turn into an AI darling on Wall Street. The stock was up 41% this year through Wednesday's close. And shares of Airbnb also falling in pre-market trading. The company posting revenue that beat analyst estimates but provided lackluster guidance for a second consecutive quarter. The company, which specializes in shared home and vacation rentals, said it sees growth slowing before an uptick in summer travel, and it's expecting revenue growth to re-accelerate in the third quarter as key international events like the Summer Olympics in Paris and the Euro Cup in Germany fuel travel demand. And some distressing news in the housing market. Approximately 1 in 37 homes in the U.S. now considered seriously underwater. Nationally, 2.7% of homes carried loan balances of at least 25% more than their market value in the first few months of this year. And that's up from 2.6% in the previous quarter. Kentucky, Mississippi, and Oklahoma saw the biggest increase in number of homes seriously underwater. And that's your Bloomberg Brief, John.
Hey, Shanali, thank you. We'll catch up with Shanali again in about 30 minutes' time. Up next on the programme, the importance of earnings.
This is an earnings-driven market. If companies are not showing investors what they like, they're getting punished very quickly.
Saw that with ARM again this morning. That stock is down in early trading and down hard. That conversation just around the corner from New York this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Live from New York, welcome to the program. Equity futures here negative by 0.1% on the S&P 500. AMH is down in Washington. We'll catch up with Anne-Marie in about 10, 15 minutes time. Lisa's going to be off for the next couple of days. I've got Danny Berger alongside me. Yields are higher by 2 basis points on a 10-year, 451.21 on a US 10-year. Under surveillance this morning, the importance of earnings.
This is an earnings-driven market. You think about 2023, it was all about repricing. It was all about multiple expansion. And because of that, the market is not cheap. And this is a year where stocks are going to be driven much more by earnings, by cash flow, by profitability. If companies are not showing investors what they like, they're getting punished very quickly.
It's the latest this morning. Stocks on pause following the biggest four-day advance so far this year. Eric Friedman of US Bank Asset Management writing this. We used equity and commodity market weakness in April to add to risk assets and sell bonds, leaving us overweight domestic equities and real assets and underweight fixed income. Eric joins us now for more. Eric, great to see you, sir. In your words, you've been trading up a storm. Can you walk us through what you've been doing and why?
Yeah, we've been active, Jonathan. I think it's been an environment where we've been using price weakness to really bolster our thesis, if you will, that we think corporate earnings will deliver this year. We also want to be protected against what we think may be an incipient inflation environment. So, we've looked at equal weight S&P as our more favored choice right now, just with a viewpoint that we want to stay in large cap, we want to stay domestic. But we also want to be more spread out, if you will, from a factor standpoint. So we think equal weight S&P is a good way to express that view. Also think that inflation is going to be hanging around. In fact, it could reaccelerate as we get deeper into this year due to both the catalog costs, if you will, shelter costs, but also just the considerations around comparables. So we think that those are two spots. We're not looking for a shock and awe, if you will, in inflation, but we do think the gradual incremental increase is a risk that we want to make sure we have protection on in portfolios.
Your favored sectors, tech, energy, financials, mid-caps. I'm putting this all together, Eric. This screams strong nominal GDP. What's your base case for this economy?
Yeah, we think the economy is still going to be really in the back of both a consumer, which is starting to incrementally slow, but is still in good shape, Jonathan, and also think the corporate CapEx cycle remains quite robust. That's something that we've seen a lot through this earnings season. The themes that you've seen in terms of spend remain AI, remain cyber, remain big data. So those are things that we think are more durable. To your point on nominal GDP, we are starting to see some participation from across the pond, which is a good thing in terms of the consumer really hanging in there, financials also being in relatively good shape. So those are all things that we think still leave us more with an overweight position bias, if you will, but also a flexible mindset. I think this is an environment, Jonathan, where if you don't have tight stops around your views, there's a level of hubris that we prefer not to have in this environment. So we think, again, more of a constructive bias, but also making sure that we're not risking too much in what's going to be a very dynamic back half of this year.
Well, perhaps part of that hubris, Eric, is also having protection for when things go wrong, for when your viewpoint doesn't play out, and for an economy that we're still unsure of. But when you look at things like the VIX of the VIX, there's nothing there. There's no one who is willing to go out and buy, frankly, these cheap hedges, Eric. So what does work in this environment?
Yeah, Danny, I worked alongside Sandy Rattray, who developed the VIX many, many years ago, and it's something that I think is a great observation just because the vol has been very, very limited. So we think doing the following makes sense. Number one is that we're underweight fixed income, as Jonathan mentioned, but we do own some what we consider longer duration exposure in the event that we're wrong. That's something that, again, we think makes sense in the event that there is a significant surprise with either the Fed or a deflationary pickup, which, again, we're not forecasting as our base case. we think that makes sense. We also think, again, that commodities exposure, which again is not energy related in terms of energy equities, but direct commodity exposure, again, that broadening out of inflation risk that you're seeing in everything from wheat to coffee to cocoa, those are things that we want to make sure that we have in portfolio. So again, having a view, having a tight stop around those views, we think that's going to serve investors well in this environment.
Well, Eric, you also said one of your views, equal weighted S&P. This is a market where over the past decade, if you had said to someone, valuations are too high, you shouldn't go perhaps to a market weighted index, you would have been wrong because the expensive companies could keep getting more expensive. John mentioned this, you look at something like an ARM earnings that is getting punished. And Eric, I wonder how much of that is down to expensiveness. Something like ARM, 27 times sales, more expensive than NVIDIA. Is this a market that cares, once again, about valuations?
Yeah, Danny, I think that's a really important observation. We think it absolutely is. In fact, one of the reasons why we went more equal weight is because that value factor, again, not that we always invest in factors, if you will, but because of our desire to want to stay large cap, we do think there's a risk of refinancing with small caps as well as the unprofitable nature of about a third of that index. Even though it's certainly lagged, we'd actually prefer to be in a higher quality lagging index like equal weight S&P. So you are seeing that stand and deliver type of market from companies right now. If you do not either have strong guidance or a good reason why you missed, this is a market which is quite punishing. So we think that there's a level of margin of safety, if you will, in equal weight that's certainly not the cheapest we've ever bought, but a space that we think is going to be well represented in a decent earnings climate for the next couple of quarters.
Well, Eric, usually the value trade does well in a rate cutting cycle, or at least when we're in that trajectory, getting to that trajectory. So how much of that is dependent on the Fed actually delivering cuts?
Yeah, we think that if there isn't one, or at least I think it's been a great phrase that you all used this morning, which is the dovish pause, if you will. If there isn't more of that dovish pause type of language, or ultimately we think one cut and at least a signal for a bias towards more, this is a market which is a bit more vulnerable. But again, for us, it's not so much when do the rate cuts start. We do think the market's starting to pay a lot more attention to the terminal value. And if you look at, again, expectations out through 2025, 2026, again, for someone who doesn't know what he's having for dinner tonight, it's hard to look out that far. But this is an environment where, that terminal rate, if you will, is becoming more important. So some cuts this year with a signal and a bias for more in 2025 are important. Not necessary. We think the terminal rate is much more important. So again, that 2 3/4 to 3 on a terminal rate side, we think would be a good place to anchor on. Higher than that would be an issue for this market.
Yeah, never mind 25. I'm struggling to get beyond next week. CPI, retail sales. Eric, it's good to hear from you. Eric Friedman there of US Bank Asset Management. An interview, a conversation which just screamed strong nominal GDP in America.
It does. I mean, again, I go back to this idea of value. In order for value to work, you need some sort of cyclical upswing, because the way that cheap companies become not cheap companies is they deliver good earnings. So it says a lot about where you think you are in that cycle if you're willing to make that bet, which, by the way, so many people over the past decade have said, now is the time for value, and it's basically always been a head fake.
Based on what he just said, overweight equities, overweight real assets, overweight commodities, underweight bonds. That is a very constructive outlook on the U.S. economy. Coming up on this program, former World Bank President David Malpass with Anne-Marie Jourdain down in Washington, D.C. That conversation is just around the corner from New York. This is Bloomberg.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
So here we are, 2 hours away from the opening bell, with equities pulling back just a little bit. We're down by 0.2% on the S&P 500. On the Nasdaq, we're down by about a third. Your next stop for this market in about 60 minutes' time. Jobless claims in America just around the corner. Very light on data this week, as we've said repeatedly on this program. Very heavy on Fed speak. More Fed speak a little bit later. San Francisco Fed President Mary Daly coming right up. In the bond market, we look like this on a 2-year. The front end of the curve, 484.48. Yields higher by almost a basis point. On a 10-year, higher by 2 at 451.41. We need to talk about some central bank rate decisions. Let's take a quick sneak peek of what's happening with sterling in the FX market. Cable shaping up as follows. The pound against the US dollar, 124.56. We are softer by about a third of 1%. That is a weaker pound sterling following this. Under surveillance this morning, the Bank of England keeping rates on hold for a 6th consecutive meeting. 7 MPC members voting for no change, 2 voting for an immediate cut. Officials also cutting their inflation outlook as well. And Danny, for a lot of people, that just sort of nudging this decision out to June, and a lot of people encouraged by this idea that maybe that's when we get that 25 basis point cut.
The market is starting to go there. It's not completely there. Gilt's little change this morning, but what we are seeing under the surface are pricings for futures for the BOE completely in August now. So we do have that priced in, because for so long, this has basically been trading on when the Fed goes, maybe the BOE will go. It was following that pricing. We're starting to see a change, and Deutsche Bank really underlines this. They game this out, basically saying, actually, the risks to sterling are not that great if the BOE goes before the Fed. The move will basically be an error, a rounding error. So therefore, they can go. The currency effect is not bad enough to hold them off, much like we saw from the Swiss and from the Swedish.
I'm guessing we read the same note, because
Probably.
This was from Jim Reed of Deutsche Bank. Was
Correct.
it from Jim?
It was from Jim.
Okay, so Jim had this to say about the Bundesbank. So if you need a long history of the ECB, we only have so much, because the euro was only a couple of decades old. So if you include the Bundesbank and just say that's the same thing. So this is what he says. The Bundesbank ECB have not eased before the Fed, apart from in 2011, when the ECB cut rates due to the sovereign debt crisis, when the Fed was already at zero and didn't cut rates further. So this is a history going back to 65 years ago, from Jim Reed of Deutsche Bank, where on the ECB/Bundesbank, it's very, very rare for them to go before the Federal Reserve, and we're about to see that potentially next month.
Maybe it's because this isn't exactly a rate cutting cycle. I mean, if they're going to cut once, twice.
I think that's the right point.
I mean, it's not the same as it used to be. They're not going to have this huge difference because inflation is not where it is. So it's, again, not the same type of impact if you start your cutting cycle, quotes, cutting cycle a month, 2 months before.
Maybe a mid-cycle adjustment. I think that's a phrase I've heard quite a few times, both here in the United States and elsewhere as well. That's the latest on the central bank stuff. Here's the latest on individual names. Shares of Warner Brothers Discovery trading lower after wider than expected losses and a revenue miss. Bloomberg reporting the company is looking for further cost cuts, including possible layoffs. And in a surprise move announced yesterday, Disney Plus, Hulu and Max will be sold together in a bundle starting this summer. We have long talked about this, Danny Berger. The return of the bundle, it is back.
I can't get my head around it. It feels like at some point there are so many bundle offerings. I'm like, this is cable TV. That's exactly what you're selling. You know, it's that jam problem. You go to the grocery store, there are too many jams, so whichever one you buy, you're unhappy with. This is the world we're getting into with these bundles.
And you end up with a fridge full of jams.
It will.
Which is what the TV looks like now.
I mean, I think the point is you buy one jam and you hate that jam. So in this scenario...
Do you throw it away, though? I thought you end up with a fridge... Anyway, we'll leave that story there.
Expired jams everywhere. And the bundle you don't watch. I think that's it.
I think that's a British thing. That is definitely a UK thing, to have a fridge full of jams. I don't see that in America so much. Here in the United States, President Biden's so-called red line on a Rafah invasion is becoming clearer. In an interview with CNN, Biden warning he'll stop additional shipments of weapons to Israel if it launches a ground invasion in the Gaza City. The US already pausing a shipment of 3,500 bombs. Rare to hear from the President of the United States directly in an interview. We actually got one yesterday evening, and very, very clear about what he thinks should happen next.
And it's a different Biden than we heard in March. He gave an interview to MSNBC there, basically saying going into Rafah, in a Rafah invasion, that is a red line. But John, he caveated that with saying there is no red line in which I would stop supplying all weapons. Now, to be clear, he's not stopping supplying all weapons, but it's a change in tone, and to your point, it's a public change in tone that he's giving on an interview that he rarely does. It is Biden trying to make a point to the Israelis.
You know, the commentary I always hear on this side of the Atlantic in the United States on the president is often, this is really important to his re-election chances, particularly in states like Michigan. And I mentioned this earlier on the program, and I know a lot of other people have identified the same thing. When you go through swing state polling, Michigan is the least of his worries. In our recent poll with Morning Consult, he's up there. He's down hard everywhere else. If you take an average of all swing states, he's down 6 against the former president.
And one of the things I go back to, one of the things that pulls extremely well that Biden has an advantage over, things like abortion rights. You don't hear Biden out there talking about that. Obviously, current events have taken over, but the messaging is the war, the messaging is the economy. There's low-hanging fruit there. It feels like he's not getting after.
Yeah, the economy very much top of the pile. Sticking with politics, 6 months out from the November election, and the next president could be heading into a, quote, perfect storm, according to former World Bank President David Malpass. Writing in the Wall Street Journal, Malpass saying, quote, the suspension of the debt limit expires January 1. This year's spending bills will likely be extended just long enough to kick the can into 25, and tax rates will rise at the end of 25 unless Congress and the president can agree to expend some of the expiring provisions in the 2017 Tax Cuts and Jobs Act. Anne-Marie Hordern, joined by David Malpass in Washington. Morning, Anne-Marie.
Good morning, John. That's right. I'm joined by David Malpass, the former World Bank head and also Undersecretary at Treasury under the Trump administration. Thank you so much for your time. John outlined some of these thoughts that you have going into next year, this perfect storm, the debt ceiling, the perennial spending fights that happen in Washington, and also this expiration of the Trump-era tax cuts. Whether it's Biden or Trump, how should the next president be thinking about all of this?
Morning, Anne-Marie and John. You have to recognize what's been going on politically in D.C., which is not making decisions, not really sorting out what to do about spending, about debt, about taxes. And so that's all pushed into 25, and that has an impact on businesses. They wait to see. So the uncertainty, I think, is what's prevailing within the economy. I don't want to invest if there's going to be a big tax increase, but I can't see what they're going to do to avoid it. And so that's the time clock that's going on now.
I'd like to talk about taxes because Ed Mills was on from Raymond James earlier this morning, and he made a great point, which is the fact that yesterday we heard from the House Ways and Means Committee Chair Jason Smith coming out and saying there's actually some Republicans who want to see a higher corporate tax rate. Trump brought it down to 21% from 35. Biden has pitched 28. Senator Joe Manchin has said maybe 25 is something we can all agree on. Where do you see Republicans and Democrats potentially having this equilibrium when it comes to the corporate tax rate?
It's a bit of a fight in the election itself. You've got a choice of, do you want the economy to grow stronger, and do you think tax rates matter? I think they really do in terms of the growth rate. If you raise the taxes, there's less investment going on in the corporate sector. We're already seeing it in the small business sector, just very hard for them to make the new investments needed to pull down or to improve the supply chain. So we're seeing this persistent inflation and stagflation.
So what do you make of Republicans, though, coming out and saying that it should be higher?
You know, all through the party unity is not as much in the Republican Party, so that they've got to sort out what is the message of Republicans, that you want Washington to be bigger. You know, it'd be fun for a lot of politicians in Washington to have a big debate over which taxes to raise. That pulls in a lot of political contributions. But what we should be looking at is which taxes affect growth the most, and you want to hold those down so that you can have more jobs, more people back to work after COVID. A lot of people are just staying out of the economy because it's not strong enough to bring them into the labor force.
Well, labor participation rate, though, is pretty high, and unemployment is below 4%. Most people would argue and would say this is a very healthy labor market, under 4% for more than 2 years.
The labor force, though, doesn't include the people that have opted out. And those are people that we need in the economy in order to really be catching up. In the meantime, China's numbers yesterday, they show their trade numbers. They're cleaning up by having factories running at full speed. I'm from Michigan. What you see is the manufacturing inventories not building. People, you know, the whole U.S. economy is waiting to see what's going to happen in terms of policy in 2025. That's this fiscal train wreck, and they want to see how is that going to be resolved by Washington to get Washington out of the way. What we're seeing right now is this regulatory push that's going on day by day. You're seeing these massive new regulations come out of Washington as an end point to the current administration. Also, the proposals for big tax increases that you're talking about, that yes, there's going to be some Republicans who say we need it, but I think the public recognizes if you give more money to Washington, it's just going to be spent. So it's not really going to help on the national debt front.
When it comes to the national debt and taxes, the CBO came out yesterday and said if we were to see an extension of the Trump-era tax cuts, $4.6 trillion. So fiscally, this would be incredibly challenging. How do you think about that? Would the bond market even allow that to happen?
This gets into what are the taxes and how do they affect growth. There's this tendency of people to do what's called static modeling, meaning they say if nobody changes their behavior, then a tax cut will just be added to the national debt. But the whole point of taxation is to raise revenue without stopping people from doing what they need to do. Small businesses reinvesting. I think we're over the Laffer curve right now in terms of small business taxation. I don't know if you saw the statistics as President Biden has proposed these big tax increases on capital gains and also on basis step up. It causes small businesses to just stop investing in their business. They look to sell to somebody big because they can't afford the taxes. So I challenge that $4 trillion statistic and say, look, you would get more growth out of the economy if you had better tax policies. You don't need to raise the corporate rate.
Okay, well, that's going to be definitely day one something, and we already see committees being formed now in Congress to try to map out what this tax policy will look like. I want to also ask you about what potentially we could see under Trump 2.0. You were an economic advisor for him when he was campaigning in 2016. You joined the administration. You ran the World Bank. When the Wall Street Journal comes out with a report and says that Trump potentially wants to put his thumb on the scale when it comes to the Fed and questions Fed independence, do you think that actually would be happening?
I saw that story. There weren't any sources. I don't think that is the policy that would create growth. You know, the Fed has, I've criticized the Fed for being too big, for inserting itself into too many markets. The interbank market is gone now. The trading of Fed funds that were so vital to the dynamism of the U.S. economy, that's gone. The repo market has been almost nationalized as you look at the amount that the Fed is controlling within that market. So I think we could have a smaller Fed, a smaller balance sheet for the Fed, and that would actually be very positive for growth. The commercial banks would love to be lending right now to small businesses, but the way the regulatory policy works, they can't do it. It's biased against small businesses, and that's true also of the borrowing that's done by Treasury and by the Fed. They're borrowing in the short end of the curve, and that's just crowding out small businesses. So I think that's the key dynamic going on.
But they're borrowing the short end of the curve because everyone thinks, why lock in rates this high at the long end? We'll do that maybe in 2 years when they come down, right? I mean, isn't that prudent?
No, that's not prudent. The yield curve is deeply inverted. So if you borrow at the short end, you're paying this 5.4% by the Fed. They're borrowing every day at 5.4% to own bonds that yield substantially less. That's not prudent. What it does do is helps prop up the stock market for now. I think there's some end game going on within the economy where it's part of the kick the can is to say, well, let's just borrow short term, hoping for better in the future. But the global markets look at that, and they're not voting for the United States on that. We're weak at home in terms of the economy, just 1.6% growth, and CBO's forecasts are for weak growth into the future. And then abroad, we've also got the weakness that's leading to wars in multiple parts of the world. And they look at the fiscal situation in the U.S., the inverted yield curve, and say, why would I invest into that high a short-term interest rate?
Two final quick ones. So one, you think under Trump there would be an autonomous Fed, and two, would you go back into a Trump administration?
Right now that's way premature. The issue is for people to sort out the policy differential. You've got a choice of weak versus strong, of growth versus stagflation. That's the decision for people to make, and Trump would have a whole array of people that could really implement a growth policy. I think that's quite possible, but it's the election cycle, so let's focus on that.
David Malpass, thank you so much for your time this morning.
Thanks.
John, of course, that was the former head of the World Bank, David Malpass. He thinks potential for going into a stagflation environment. We should remind the audience what Jay Powell recently said about that. He doesn't see any stag or any inflation.
AMH, thank you. On the challenges of 2025, the World Bank president, former World Bank president, David Malpass. If you are just joining us, welcome to the program. I want to check out sterling just quickly. The pound weaker against the US dollar, down a third of 1% at 124.58. The Bank of England 45 minutes ago, leaving rates unchanged at 5.25. The news conference on Threadneedle Street underway. Governor Bailey saying it is likely we will need to cut the bank rate. We will need to make policy less restrictive. Rates may fall more sharply than markets expect. So, hello, June, maybe. Take a listen to what he had to say about the month of June. A June bank rate cut, Danny, is not ruled out or planned. Helpful.
Very helpful. That's how I find basically all of his comments. And one, he says, don't interpretate the ups and downs of data. Oh, but also we need the data to help us interpret where the CPI is. John, I think you put it really well, that this is about giving himself optionality. But you can see in those last comments, he can't help himself to have that dovish tilt. It was only in January of last year. Remember that whole thing of we're turning a corner, yes. We're almost there. And here we are over a year later, we're not really, maybe we're kind of almost there. You can still see that impulse from him creeping out.
It's like a 3-month rolling view.
Yeah.
It's always 3 months out. Maybe it's another 3 months out. Sterling's weaker by about a third of 1%. Cable at the moment at about 125. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Shanali Basak. Hey, Shanali.
Hey, John. Chinese President Xi Jinping appears to have wrapped up his trip to Serbia without visiting the site of the former Chinese embassy bombed by NATO forces. Xi timed his arrival in Serbia to coincide with the 25th anniversary of the bombing, where U.S. missiles killed 3 Chinese journalists. The White House later called the strike a mistake and blamed it on faulty maps. She wrote an op-ed published in a Serbian Politica newspaper on the day of his arrival, vowing to never forget the attack. MAGA has joined TikTok. It's the first Trump-affiliated account on the Chinese social media app. The Super PAC's first videos, posted under the handle @MAGA, attack Biden's economic record and label the independent presidential candidate Robert F. Kennedy as a radical leftist. Trump and President Biden, who has been on TikTok since February, have both supported a ban of the social media app due to national security concerns. And living in Manhattan is getting even more expensive. Apartment rents rose to a new high for April. Leases were signed at a median of $4,250, up $9 from the same time a year ago. That's according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. Rents have climbed annually in 3 of the past 4 months, suggesting that another record-shattering summer is to come. That's your Bloomberg Brief, John.
Shanali, thank you. We'll speak to Shanali again in about 30 minutes. Here's the deal. Yes, it's a lot of money. People are paying it. This is what stands out for me. Leasing has soared 42% up on last month in April over 2023.
You're just tempting this rant from me about how there are too many people in New York.
Indulge me. I'll be with you.
There are just too many people here, too many people willing to pay that. You know, it's the bank, the consultancies, they all overhired. They're still here and paying those rents.
Inventory in Manhattan rising 23% from a year earlier. So that churn that they're speaking to is starting to happen. It's a lot of money, but people seem to be paying it here in Manhattan. Up next on the program, the case for commodities.
We have already shifted towards commodities with an overweight there. A commodities position we think is probably a smart thing to do at this point.
We'll catch up with the brilliant Javier Blas up next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Equities pulling back, stocks down by 0.1%, no drama here. Yields are higher by a single basis point on a 10-year, 450.62, and crude rallying by 0.7%, 79.55. Under surveillance this morning, the case for commodities.
We have already shifted towards commodities with an overweight there. Again, you know, the non-correlation, we like that about commodities. We've certainly seen precious metals performing well, gold in particular, and we think that oil does have some upside from here. So, you know, a commodities position we think is probably a smart thing to do at this point.
Here's the latest this morning. Soft commodities rallying this year with extreme weather and shortages driving prices of coffee and cocoa higher. Javier Blas of Bloomberg Opinion explaining one more reason why coffee is rallying, writing this. For long, coffee was one of the few commodities that one could still analyze without paying much attention to China. That's not the case anymore. Javier joins us now for more. Javier, talk to me about that. How great a source is China now of demand for coffee?
Well,
you were looking at the coffee market 20 years ago, you didn't even have to think about China. Even 10 years ago, China was not even on the top 15 consumers. Today is the 7th largest consumer. This is from a country that has been always, almost synonymous with tea consumption. China now is a big factor in the coffee market. It's not the main reason why coffee prices for Robusta, that's the cheaper bean, are the highest in 45 years. That's mostly weather in Vietnam, but it's increasingly a factor in the market and a factor that we need to consider.
Javier, how much of this is about the fact that it's a cheaper bean, that it's not the expensive stuff that, people who can afford it will keep paying up for?
Well, it is a factor. I mean, let's look at the fundamentals of the Robusta coffee market. The biggest producer is Vietnam. It has suffered with a heat wave, drought, so that has been denting production. And we saw roasters of coffee last year. They were very aware that we were living on a cost of living crisis, that consumers were going to probably trade down and try to get cheaper alternatives. So the demand from the roasters for Robusta beans went up in expectation that there will be more consumption for it, and expecting that the supply was going to be there. Then the supply was not there because of Vietnam, and that's the combination, that increase in demand coming from the roasters, expecting that the need for a cheaper blend, and then the supply failure, the crop failure in Vietnam.
Well, usually it's the demand mechanism that sorts this kind of thing out, Javier, that it's really expensive now. So you get someone like a Starbucks where people are less willing to buy their fancy coffee drinks, so therefore they're not selling as much, they're not buying as much. But you mentioned the big issue here is the supply issue. Do we need to start thinking about these soft commodities in a very different way, considering what climate change has done in terms of storms and extreme weather?
I think that we need to think about soft commodities as being always exposed to weather. Coffee in particular has been particularly exposed not to heat waves and droughts, but mostly to frost in Brazil. We have big frost in the 70s that really damaged the crop. In one weekend, at what point in the mid-70s, we lost half of the crop of Brazil just because we have a big frost, and that was it. But I think that we need to see these commodities as areas where the demand continues to increase, where the elasticity of demand to prices is very low. We are going to still consuming a cup of coffee every morning, almost no matter what the price is. And where, let's be honest also, the price of the commodity makes a very small fraction of what we pay on the Starbucks. That's a lot about salaries, a lot about marketing, a lot about the profit margin. It's very little of that, whatever it is today on the Starbucks. Every time I visit New York, I'm really shocked by the price of a coffee in New York. That has very little to do with the price of coffee in the market.
I appreciate the complaint. A lot of people agree with you. Javier, just quickly, this is softs. It's not just softs, it's hard as well. Copper has rallied. It's all about supply there too. See the same thing in iron ore. Iron ore starting to pick up as well. Would you go as far as calling this a perfect storm for commodities on the supply side?
I would not say that. I mean, you look at other commodities, wheat, corn, soybean, prices are coming down, rice prices are coming down, even olive oil, which I care a lot, the prices are starting to come down. But there is an element of supply shortages in some commodities. I think that copper certainly has a lot of upside to go up in the next few months and years. Oil is a bit more balanced, supply and demand are balanced. The price is going to stay between the range that we have seen so far this year, between $75 and $95 a barrel. So I would not go to say there is a very bullish story for commodities in general, but certainly for some of them, there is a bullish picture.
We should avoid the olive oil argument, Javier. Let's leave that there. Javier Blas, a Bloomberg Opinion. Javier, enjoyed the article. As always, sir, thank you. Lots to talk about this morning. Underway at the moment, a news conference with Governor Bailey of the Bank of England. Here's another headline for you, Danny. No law that says the Fed must move first from the Bank of England.
I love the idea that there would be a law like this. That's a great idea, Andrew Bailey. We should get that.
Sometimes we have conversations as if there is a law that we have to wait for the Fed. More on that in just a moment. We'll catch up with David Leibovitz of JP Morgan, Pooja Sriram of Barclays, and Bloomberg's Geetha Raghunathan and Mandeep Singh. That's all coming up next from New York. This is Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
In terms of the soft landing playbook, you know, that's still up in the air.
We do think that we're going to see more of a soft patch.
I think it's important to recognize that the balance of risk has shifted when we talk about rates.
I think every meeting is open to the Federal Reserve. We either go in September or we wait until December, but I wouldn't rule anything out.
Their biggest concern is if things go south, how fast do they go south, and what do we really do?
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
So last week we were overwhelmed by economic data, and we've said all this week that we're light on data. A sprinkle of it this hour, 8:30 Eastern Time. Jobless claims just around the corner. A little bit more Fed speak this afternoon, going into tomorrow and onto the weekend. We need to talk about 8:30 Eastern Time. Jobless claims. We'll get our hands around this economy and what it means for the Federal Reserve, and what the Federal Reserve means ultimately for everyone else. And at the moment, not much, it seems. We've already had a cut from the S&P out of Switzerland. We've already had a cut from the Swedish over at the Riksbank. And the Bank of England saying this, Danny, just moments ago, no law that says the Fed must move first for us to make a move.
That is indeed correct. There is no law that says they must do that, but we've heard this from Lagarde, right? And basically every ECB speaker saying that we don't need to wait from the Fed. The Swiss and the Swedish showed us that indeed they don't need to wait for the Fed, but the calculus, John, becomes different if we're talking about waiting for the Fed past this year. What happens if the Fed doesn't cut this year? What happens if they don't cut until late 2025? And they've already started their cutting cycle. That's perhaps when you get the trickiness.
This is where rate differentials get a little bit more difficult for some of these central banks. It might not shape when they start. It might shape how far they can go. We'll have that conversation in just a moment. Andrew Bailey, the governor of the Bank of England, speaking in this news conference, underway, started about 32 minutes ago, had this to say on the outlook for inflation. 2 more prints before a June rate decision. And the MPC now sees the second round inflation, if we can call it an inflation shock, fading faster than previously anticipated. So things seem to be inching towards a 25 basis point cut from this central bank.
He also, though, did say that he expects inflation to edge up later this year. So wrap your head around that. He's saying 2 different things potentially at once, but it just goes to show that they don't exactly know the path of things going forward. He made the mistake before of saying we're going the right direction. Here he is giving himself an out if it doesn't go that way.
It's a word you hear a lot on Wall Street. It's optionality. They always want the option in either direction. The pound against the US dollar, a little bit weaker by a couple of tenths of 1%, in at around 125 at the moment. The broader price action, we're down 0.2% on the S&P, just a little bit weaker going into the opening bell in about 88 minutes time. In the bond market, yields are higher by 2 basis points. The 10-year 4.51.41. And a broader look at the FX market beyond sterling into the euro weaker as well, against the dollar at 107.29. Coming up this hour, we'll catch up with JP Morgan's David Leibovitz as stocks snap a 4-day winning streak. We'll speak to Mandeep Singh of Bloomberg Intelligence as chip makers become a geopolitical flashpoint, and Pooja Sriram of Barclays on what it would take for rate hikes to re-enter the conversation. I can't keep up. We were talking about hikes, then cuts, and now hikes again. We begin with the big issue. Awaiting the next big data point. Market momentum stalling as investors look ahead to next week's CPI print. JP Morgan's David Leibovitz saying this: for investors, so long as the Fed remains biased to cut rates at some stage, we think risk assets will remain supported. David joins us now for more. David, good morning to you.
Morning. How are you?
Is that the bias, and did it change last week in any way, shape, or form?
So it's funny because when we think about and when we talk about what happened last week, I would describe the market as almost spastic, right? We started with a very hot ECI print that everybody was pricing out cuts. The Fed's not going to be able to go this year. We ended with a non-farm payroll report, which was effectively Goldilocks. So there was something for everybody last week, and you could see that in the way that the market was moving. I think the most important thing was what Powell said during the press conference. And when he laid out the potential scenarios for interest rates this year, he didn't really talk about hikes. He talked about staying on hold. He talked about easing policy. And we've actually done some work and looked at whether it's the stock of cuts that the market is expecting or more about the flow. And as long as the market is continuing to price in cuts over the next 12 months, we think that that's going to keep long-term rates in a range and likely leave equities fairly well supported.
So let's do some scenario analysis. So Christian Mamani was sat in your seat just yesterday, and he was saying there's 2 worlds. There's one where the economy's great and the Fed can't cut, and there's basically one where the economy starts to soften and the Fed can. Right. Is there a better outcome for markets?
I don't think there is. I think that the latter may be slightly better for the market. The market is clearly getting a little bit twitchy about this very robust pace of nominal growth. And the issue is you're getting the earnings coming through, but you're capped on multiples given the subsequent outlook for rates. And so I actually think a little bit of softening in economic activity, maybe getting the Fed to acknowledge that easier policy really is on the horizon, that could be the ideal scenario. Very much going back to a world that feels like the one we were in for the better part of the expansion post-GFC.
And you can feel the market's desire to get back to that. We keep referencing back to that, but I wonder in what you were talking about Powell laying out all these scenarios where he very well could have said that would lead us to hike. He says that would lead us to not cut. Is that the Powell put?
I think to an extent it is. And I also think it's important to recognize what the issue is that they're dealing with, right? So the Fed has this dual mandate for full employment and price stability. They don't really need to be worried about the employment situation, at least given the data that we've seen. And so inflation remains public enemy number 1. And what I think would lead the Fed to become more hawkish is if we saw that re-acceleration in inflation, which in our view would be directly tied to a labor market that heats right back up. And so if we see non-farm payroll prints go back to 300,000, that could well give us a bit of pause, but it feels like the overall direction of the labor market and the wage data is supportive of some easing later on this year.
And then we have a quiet week. We get some more of that data next week. But here's the thing is, it seems like we're in a bit of a no man's land during that data because earnings season will be over. We won't have all those cues for corporations. We're a far ways out now from the next Fed decision. So what does it mean for each of these data points when we're kind of in the middle of nowhere?
Well, it's interesting because to your point, it's really the level one data, right? The CPI numbers, the employment numbers that tend to move rates and subsequently equities. In particular, I actually think that it's not the worst thing in the world. We have a somewhat quiet week. The market can digest what it learned last week. I mean, we got a lot of data last week in the US, around the world. The market can process that, and the market can listen to what Fed speakers have been saying, right? We're seeing, relative balance between those that are continuing to talk about easing later on this year and those that may be a little bit more hawkish, like the man from Minnesota and his blog yesterday. And so, when we think about what the market is going to do this week, it's going to digest that data. And frankly, the outlook for the economy looks pretty good. 2Q growth is tracking nicely. We may see a bit of a deceleration in the second half of the year, but again, back to where we started the conversation, I'm not sure the market would dislike that.
But the bar is higher, and we need to talk about that data relative to expectations. So let's take the City Surprise Index, looking at US economic data incoming relative to what we were expecting. It is nosedived over the last month. It's turned negative in the last week. Do you think there are better opportunities abroad? Do you think we've reset the bar low enough abroad that we're starting to beat expectations at the same time they're starting to deliver rate cuts?
So the international story is an interesting one. The thing I will say about the U.S. economy before we move on to the rest of the world is we were thinking about the various kind of pillars of growth as being assets or liabilities or neutral. There's a lot in the neutral bucket today, but that does skew a bit more toward the liability side than the asset side. And I think that that's supportive of slower growth in the U.S. during the back half of the year. Now, the counterpoint to that is the rest of the world is picking up. Right, if you look at kind of the edge of the world being Southeast Asia, what's happening with semiconductor activity and overall technology exports, things have picked up quite nicely. We're seeing some green shoots finally begin to emerge out of Europe, and that makes us constructive on a pickup in the overall global manufacturing and global goods cycle. And frankly, what we need to see is the European consumer come back. Because if the European consumer comes back and that source of demand reemerges, we'll see the inventory cycle pick up, we'll see that manufacturing activity reaccelerate, and we'll see Europe emerge from a relatively soft period of economic growth.
What is it about the phrase Europe and green shoots? I feel like we say Europe green shoots for like 10 years, same story.
Exactly. I think it's definitely become convention, but I think that the reality here is that you've seen an extended period here, 18 to 24 months, where manufacturing activity globally has been soft. You're not only seeing things pick up in Asia, you're seeing things pick up in Europe, you're even seeing things pick up in the US, barring that most recent ISM manufacturing print.
Okay, but once we get the cuts coming out of Europe, what happens not to the landing, but after the landing? I know you're seeing green shoots, but is it enough to get some sort of growth coming back into Europe?
So I do think that we can get growth going in Europe again. And I think, one of the bits that we've been really focused on as of late is the response to the pandemic, right? So in the US, you had, money dropping from helicopters, people got laid off, but they got a stimulus check in the mail. That created too much money chasing too few goods. Europe had a different approach, right? They furloughed their workers, they put them on a percentage of their overall salary, and I think that led the consumer to just retrench a little bit further. And so as we see consumer confidence begin to pick up, and as we see signs that the labor market is remaining healthy, that does make us more constructive on opportunities in Europe than we have been up until this point. The one thing I will say is that the folks who like to point to, well, you can invest in semiconductor producers in Europe and technology in Europe, it's as expensive as tech in the US, right? So that's a completely different conversation. This is more about picking up the cyclical trade and jumping on board as things begin to accelerate.
But it is so hard to remove the American bias and go overweight Europe. Is now that time then?
So it's a good question. The thing that's really plagued that trade for the better part of the past decade plus has been the strength of the dollar. And so I think that the way to weigh this and to think about this is, if the ECB is easing and the Fed needs to stay on hold, what happens to the euro? Right? Because if we can get that euro strength and maybe the Fed easing as well, that's going to be an additional tailwind for US-based investors in European markets. If we have a Fed that keeps rates where they are and an ECB that starts easing, I think that even if you see a pickup in local market activity and local currency returns, the dollar may well work against you.
Wait, so square those two for me. European growth is better. Go into not just the expensive tech, but at the same time, by all accounts, the Fed is not going to cut as soon as the ECB. Dollar remains strong. Which wins out?
So I think if the Fed is able to ease, and our view is that we will get 1 to 2 cuts before the end of the year, you will see some of that euro strength begin to come through, and you will be able to participate in a recovery across the pond.
We've got a lot to talk about. You're going to be sticking with us. David Leibovitz there of JP Morgan Asset Management, sticking with us for the rest of this hour. This week started with a conversation about US exceptionalism and just how exceptional that exceptionalism actually is. Peter Chi of Academy asked that question. He's right to ask it based on how the data's come in relative to a much higher bar.
Yeah, and I'm gonna, channel my inner Lisa because she's not here. The debt is certainly exceptional.
Okay.
Perhaps that's the exceptionalism that we see, but can a country be exceptional with this huge debt pile? It is a concern. More folks are talking about it. I don't know, maybe it's not so exceptional with that considered.
You say Bramo, and I go straight to the Bloomberg terminal. For anyone with a subscription, ECO20 space US supply. 30-year bonds, $25 billion worth, coming a little bit later this afternoon. Bramo, if you're at home watching, that was for you. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief with Shonali Basak. Hey, Shonali.
Hey, John. Speaking of bonds, the Bank of England has voted to hold rates steady for a 6th straight meeting. 7 MPC members voting for no change, with 2 votes for an immediate cut. Officials also cutting their inflation forecast. Governor Andrew Bailey saying that he's optimistic that things are moving in the right direction. And Bloomberg is reporting that Alphabet is in talks to buy marketing software provider HubSpot. Discussions are ongoing. No agreement has been reached, according to people familiar with the matter. The deal would allow Google's parent company to better compete with Microsoft, Oracle, and Salesforce. HubSpot has a market value of about $30 billion, meaning this could be one of the biggest takeovers of the year. And shares of Warner Brothers Discovery trading lower after wider than expected losses and a revenue miss. Bloomberg reporting that the company is looking to further cut costs, including possible layoffs. And in a surprise move announced yesterday, Disney Plus, Hulu, and Max will be sold together in a bundle starting this summer. And that's your Bloomberg brief, John.
Shonali, thank you. So I'm losing count. So I've got Hulu, and within Hulu I get Disney Plus, and I get ESPN. So now I'm going to get Max as well. Is that right?
And then I think, Verizon, I think they have something where you can get Max and Netflix too. And then remember that whole thing of everyone teaming up together and also offering sports. So sorry, you thought you got to just choose between. Yes, that too. So there's, plenty of bundles to choose from.
Because separately, of course, Netflix, Prime, Paramount for the Italian football, Peacock for the British football.
Right.
This list just goes on.
You're just buying for football at this point.
I pay more now than when I first moved to this country and got cable and just had the full package with the sport and everything. I didn't pay for any of this stuff. I pay way more now than I used to.
Yeah, well, I'm just sticking to cable and Netflix. That's all. I can't be bothered. Honestly, it's too much to figure out.
The bundle is back in a big way, apparently. Up next on this program, the Morning Calls. Plus, we'll catch up with Mandeep Singh of Bloomberg Intelligence as chip makers weigh the impact of new U.S. restrictions on Huawei. That conversation just around the corner. Live from New York City this morning. Good morning.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Here's the price action for you on the S&P 500, negative by 0.2%. Just a little bit softer going into the opening bell, about 1 hour and 14 minutes away. It's time now for the morning calls. First up, Citi, raising its price target on Uber to 93, maintaining a buy rating. The ride-sharing company, still one of Citi's top picks, as it sees booking and profitability growth. Your second call from JMP Securities, raising its price target on Instacart to 42, sticking with an outperform rating. The analyst citing stronger first quarter earnings and the company's new restaurant delivery deal with Uber. And finally, JP Morgan raising its price target on ARM to 115, keeping an overweight rating. The analyst highlighting another positive quarter driven by a jump in chip design activity. Even with that stock getting absolutely hammered this morning, we're down in the pre-market by more than 8%. Let's stick with the semis. CFRA maintaining its positive fundamental outlook on the chip industry. The analyst Angelo Zeno saying the Commerce Department's blacklist of Huawei won't negatively impact US firms, writing this: we anticipate no change to Qualcomm's revenue outlook, as the company already cited that it planned to completely stop shipments to Huawei by the end of the year. While the impact on the industry is not a needle mover, China remains a long-term risk to the supply chain. Investors should expect more sanctions to come through the pipeline. Mandeep Singh of Bloomberg Intelligence joins us around the table for more. Mandeep, good morning.
Good morning.
Can we talk about how some of these chip makers are navigating very choppy waters over in China?
Well, so in this case, I think it may actually help Qualcomm. I'm not so sure about Intel, but Qualcomm in their last earnings call called out how they were gaining traction on the premium side. They use Android, and all the OEM makers like Samsung, Oppo, Honor, which are Huawei competitors in China, use Qualcomm processors. So in this case, if you're sanctioning Qualcomm from supplying the modem and the connectivity chips, which is also part of their business, that actually helps the other OEM Android makers who may actually see more business. So I do think Qualcomm in this case benefits. Intel, I'm not so sure, because if you're not providing the CPU that goes into a Huawei laptop, does it benefit Dell, Lenovo, HP? Not so sure about that.
The companies have been preparing for a lot of this for a long time now. Could you talk to us about NVIDIA? Reports May 22nd. What have they been doing in anticipation of some of these moves around China?
I mean, we know they have come up with a scaled-back version of their chips, and that's how they've been skirting the, the restrictions on the latest end of their chips. But remember, NVIDIA has got, pretty much the entire GPU space to themselves, in the sense that everyone needs whatever they can make off. So even if they're making a low-end chip, market is taking it. And especially, I think the Chinese OEM companies that are trying to catch up on the AI side, they don't mind taking the low-end chip because they don't have, what's alternative? And so in that case, I think it hasn't affected NVIDIA in a big way, barring an outright ban where you can't sell to the China market at all. That's when it will hit, I think, NVIDIA. But for now, this news is actually, it may be good for Apple too. I mean, think about it. If Huawei can't make a good smartphone, and that too, they were targeting the premium end of the market, it benefits Apple to an extent, because suddenly the iPhone is a viable alternative, and as is an Android OEM maker. So I think this is targeted to driving, helping to an extent the US phone makers as well as the alternative to Huawei in China.
Mandeep, how long until the conversation turns not from what is the impact of US restrictions on China, but kind of the EV conversation of the homegrown Chinese players coming up and posing a real threat? How far away are we from that?
Well, so again, when you look at all these, car makers that are coming up with new designs, Xiaomi being another one that's quite prominent, they have come up with their own EV. They use a lot of components. So as long as you, limit the supply of those components to someone like BYD, it can't innovate as fast as a Xiaomi or a Tesla can. So I think right now the restrictions are going to that level where you really pick your spots, and that's how you can make a difference in terms of, applying those restrictions.
And how are you thinking about the overall cycle? We were talking during the prior segment that we're seeing signs that overall semiconductor activity is picking up in places like Korea, places like Taiwan. How much runway do you think this all has, particularly in light of some of the political issues that are now coming into play?
I mean, look, right now, every sovereign is trying to build as much capacity as they can on the AI side, because everyone realizes, this is the cutting edge stuff. This is what the governments need to focus on. So I'm not surprised every sovereign is investing in such a big way. and you just kind of focus on the things that really matter in terms of the early stage infrastructure. Remember, applications and software will come much later. Right now, it's all about setting up that infrastructure that can propel you to the next wave of AI and innovation that's about to come.
So it's fair to say you see more opportunity in the picks and shovels today than you do in the things like the software.
I mean, this is a multi-year secular trend, and we are still in the very early stages. And right now, everyone is trying to get their hands on as much capacity they can when it comes to these cutting-edge chips.
Why isn't the market then rewarding someone like ARM, who says our next venture is to help develop the things that go into the data center? Surely the market would say, great opportunity, ARM. Instead, we see the opposite.
Well, there is a price for everything, right? So when you're a company that's trading at 30 times price to sales, you have to ask yourself how much of the good news is already embedded in the stock price. And in this case, there was nothing wrong with the quarter. It's just the expectations had got to a point where you have to beat and raise like NVIDIA does. You know, and not everyone can deliver results like NVIDIA.
How much, well, by the way, ARM is more expensive than NVIDIA, so that tells you something. How much of this, though, is just the fact that SoftBank still owns, what, 90% of these shares? I mean, there's barely any float out there, so if you want to buy, the supply is so little. Can you say that's the impact, not necessarily that expectations are really high?
I mean, I haven't looked at the short interest, but, you know, all these things matter when it comes to when the company reports and what impact it has on the stock price, the knee-jerk reaction. But I would say long-term, the story is intact. There are a lot more ARM design wins. ARM is going into data centers as well as, you know, in a lot of the edge stuff. So clearly, they have that wind on their back. I mean, the valuations did get ahead of themselves, and sometimes you see that sort of reaction.
ARM is down about 7.5% in early trading, to Danny's point. Doesn't take much to push this stock around at the moment. Just to confirm, NVIDIA reporting May 22nd. Mandeep, thank you. It's good to see you. Mandeep Singh there of Bloomberg Intelligence. David, you nailed it, I think. That's the big question we've all got. How long is this runway? How many more quarters can NVIDIA keep coming out and just saying, yep, beat raise, beat raise, beat raise?
And I think that's the big question, particularly coming out of this earnings season, where we really saw that the dent in the armor was vis-a-vis the guidance. You know, you could have beaten on sales, beaten on earnings, but if you didn't upgrade your guidance, you got completely pummeled the next day in the market. And so how long can these companies maintain these growth rates? I think you make an excellent point about the fiscal impulse when it comes to all of this and the sovereign spending that's being funneled in. But at some point, I think expectations just become too high and you settle into some sort of sustainable rate of growth.
Can we talk about these outside moves that we've seen as well post-earnings? I know you can't do single names, but I'll tease some of them out. ARM is one, a move of something like 8% this morning. We saw a double-digit move in one direction on Meta, saw something similar on Tesla, other big tech names as well. What's the signal you take away from that?
So we actually crunched the numbers at the index level, and if you beat on earnings and revenues and increased your guidance, you were flat relative to the market the next day. If you beat on earnings and revenues but didn't upgrade your guidance, you were down 150 basis points relative to the benchmark. I mean, I think that tells you all you need to know is that expectations potentially have just become overextended for some of these names. Yes, nominal growth is robust in the United States, but as we talked about earlier, that's not necessarily going to last forever. And so I think what you're seeing are people kind of readjust to a world where real growth isn't 3% with, 3 to 4% inflation on top.
So, John, I also asked that question to Peter Scheer, who had a much more technical answer. He said these things moving 10% like penny stocks, it's a liquidity problem, that people aren't really playing in this market. People have pulled back. Do you see any degree of that too?
I mean, you've definitely seen people step back from it being all about tech, and you've seen the market broaden out. Financials in particular have been behaving quite well. I think that could well be a part of it, right? Liquidity always matters when it comes to those outside moves, but when we think about more of the fundamental story, right? These stocks were trading at valuations that were simply extrapolating current rates of growth, nearly indefinitely into the future. And we all know that at some point you need to land the plane, and I think that's what we're in the early innings of beginning to see.
I love what Pete said over the weekend. 10% is the new 1% for mega cap tech. We're talking about trillion-dollar names moving double digits, which is just unbelievable. Coming up next, breaking jobless claims data just around the corner. 4 minutes away, we'll catch up with Pooja Sriram of Barclays, here to react alongside David Leibovitz of JP Morgan Asset Management. As we count you down to a little bit of data in America, equity futures down 0.1% on the S&P 500. Yields are higher by a single basis point on a 10-year, 450.82.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Some data for you, just moments away. Equities right now pulling back by 0.15% on the S&P 500. A little bit lower on the Nasdaq. We're down by, let's call it 0.2% and round that down for you. Switch at the board and get to the scores in the bond market. Going into jobless claims, yields are a little bit higher at the longer end, up by 2 or 3 basis points on a 30-year at 466.66. And on the 10-year, 450.62, up by a single basis point. With jobless claims, Mike McKee, the estimate is 212. The number is
231, kind of a surprise here. Remember me, I used to do economic data here, but when we used to have data. First data point of the week, 231,000. That is quite a change from what we had in the previous month. The continuing claims at this point look like they've gone up. I'm waiting to get the change from the revisions, and they're at 1,785,000. The initial print last week was 1,774,000, so a slight rise there. Okay, 209 is the revision to last week, so we go from 209 to 231, and we go from 1,768,000 to 1,785,000. So not a huge rise in the continuing claims number, but a fairly big proportional rise in the initial jobless claims number. But we've been here before, so we have to see if this continues.
Yeah, we have. We've got up to these levels and then dropped back down towards 200K again. But nevertheless, the question will be asked at 231 versus the estimate of 212. What is the difference between a welcome cooling in this labour market and an unwelcome deterioration? Let's turn to the price action and start with equities. We'll turn to bonds and then get to foreign exchange. Equities are positive off the back of this and now just about unchanged on the session on the S&P 500. Bear in mind where the bond market was. Switch up the board. Yields were higher by a basis point or two at the long end, and now we're lower by about a basis point on a 10-year at 448.65. So we unwind some of that move. Likewise on a 2-year, down a single basis point to 482.17. So all of this is marginal stuff. If you get to foreign exchange, I can tell you the euro is erasing losses from earlier this morning, now just about unchanged at 107.44. So, Mike, that is the question that will be on people's minds. Looking at a number that reads 231 against an estimate of 212, are we seeing a welcome cooling in the labour market or an unwelcome deterioration?
Well, unfortunately, with this high-frequency data, it's going to take you a number of weeks to find it out because, of course, it's the first time in a while that we've bounced up. Now, do we stay up? Are companies laying off more people, or is this a one-off that we have to figure out going forward? That's the hard part with this data.
I know we ask this every time, and it feels like it needs to be asked again. What's the usefulness of initial job claims to give us any sort of signal value?
Only in a sort of an aggregate over time period. On a weekly basis, it doesn't add a lot to it, but it does suggest if you see two things. A rise in the initial claims over a period of time suggests that companies are starting to get rid of workers because they see something that worries them. And a rise in continuing claims would tell you it's getting harder for people to find jobs. Now, we had this, as John said, a couple of weeks ago, and then it went away again. So you got to be extremely careful in deciding this is something that matters.
I would also add it's the highest frequency indicator we have for the labor market, and so if you're trying to keep your finger on the pulse of what's happening, it's arguably good to look at, even though it's a little bit noisy. What I think is interesting about the print this morning is, claims had kind of been sitting on one side with respect to being, very tight, running hot. You're seeing it moderate and move back in line with the broader set of U.S. economic labor market data. And so, Mike, I'd be curious from your standpoint, when you look at the U.S. labor market today, zoom out, think about all the indicators, non-farm payrolls, jolts, et cetera, where do you think we are from a slack perspective? Do you get the sense that the labor market is moving in the direction the Fed wants it, or do you think that we're still sitting here pretty tight and there's a bit more progress that needs to be made?
Well, both. I think that we're moving in the direction that the Fed wants it. Again, it's hard to tell from jobless claims, but when you look at jobs created, when you look at the decline in JOLTS openings and other indicators, it does suggest that we are seeing the labor market come into better balance. I don't want to sound like Jay Powell.
You do.
But even at this point, I mean, 175 in jobs is still a big number.
Right.
And so balance is a better word than getting rid of a lot of slack. And we're not really sure what's happening with all the immigration into the U.S. How many of those people are going into the labor force seems to be a lot of them that keeps us able to hire and helps hold down wage gains. But we'll have to see.
We're light on data this week, but over the last few months, there's enough data for everyone to construct whatever argument they want to make. Let's construct a really bad one of the US economy right now. It's easy to do. Let's take the data from last week, exclude the ECI, and go to payroll. Smallest gain in 6 months. Wages, slowest pace in nearly 3 years. Go elsewhere and look at the ISM. First contraction since 2022, below all estimates in our survey. Business activity slumping to a 4-year low. Input costs going in the wrong direction. 231 on jobless claims. We're starting to see an upside surprise there too. David, we could sit here and make this sound really, really gloomy and say Q1 strength, head fake. This is going in the wrong direction. What's the counterpoint to that?
So I think that the counterpoint to that is when you peel back the layers of the onion on the first quarter GDP data, you saw final domestic demand still very robust. And so, yes, we can interpret all of this as a beginning of, a cooling in the labor market, a cracking in the labor market. But, the counterpoint that you can make to that is we're starting from a very positive position. So unlikely the consumer just falls out of bed overnight. At the same time, you're seeing business confidence begin to pick up. You're seeing CEO confidence begin to pick up. That could well lead to an improvement in investment spending and manufacturing activity this year. And I don't think you would be getting that signal from the corporate boardrooms if they didn't perceive the end demand to be there. Now, I will admit, oftentimes when you get a couple of negative prints on non-farm payrolls, the NBER comes out and says, hey, you know what, we were in a recession, we just didn't know it at the time. And so that does always exist as a risk. But I think the fact that you're hearing business leaders continue to illustrate and remind us that demand is robust gives us confidence that the economy is unlikely to roll over.
Why do you think they're fragile, though? The narrative is so fragile over the last 12 months or so. If you think about where we've been, we've had hard landing, soft landing, no landing. Started this year, we had 7 cuts, we went down to 1, we brought a few back in. Why has that narrative been so fragile over the last 12 months?
So I think that it's a relatively simple answer is that, a lot of us have never been in a situation like this before. And, we went through COVID, we went through the pandemic, none of the economic models worked, all of our forecasting was completely off. And now we're kind of dealing with this reemergence of consumers globally that, a lot of people just don't have experience with. It was just a couple of years ago where people were talking about embarking on the roaring 20s, right? We're going to have this period after the pandemic
still are,
where
just for the record.
people are out and they're spending and they're consuming and it's about doing it today and not waiting to do it tomorrow. That narrative is completely faded, but frankly aligns pretty nicely with what we've been seeing over the past couple of quarters in particular. And so I think it's just unique, and that's the nature of where we are.
Let me also point out the Atlanta Fed came out with their latest second quarter GDP Now number yesterday, and it's 4.4%. Right. Now, it's really early, and that's really high, and that'll come down, but it is kind of funny that we're seeing signs of strength in some areas. The Fed is like a driver who's stepping on the brakes. They want to step on the brakes, but not so hard that they get rear-ended by recession. And at this point, they don't know. We're going in the direction they want because they've raised rates and the economy's slowing. How far? Did they do too much? We don't know.
Well, I think what's really interesting, if I can just jump in quickly, is if you look at high yield default rates, they've remained very low because a lot of these companies were able to term out their debt in a fixed rate fashion during the very low rate period of 2020 and 2021. If you actually look at bankruptcies in the United States, that number is rising. A lot of those businesses rely on floating rate debt, and so I think one of the things that gives the Fed a bit of confidence that they are applying the brake in the right way is you are seeing that impact of higher rates finally begin to filter through and show up in some of the data after a period of tremendous resilience.
That is something so many people have said. Look, everybody refinanced. We're okay now. It's okay if rates, stay higher for longer because everybody took out cheap debt. But that was in 2020 when the Fed started to cut dramatically. We're 4 years out, David. Are we not finally starting to face some manner of a maturity wall?
So you are beginning to face more of a maturity wall than had been the case. I think it's important to look, though, at the share of debt outstanding that the maturity walls represent. It's mid to high single digits for both high yield and investment grade. The real issue is in private credit, right, where that number is, call it 15% over the next couple of years. Now, private credit loves nothing more than to amend and extend and kick the proverbial can down the road. So will that lead to defaults? I mean, your guess is probably as good as mine. But what you've seen, and now particularly with the bank loan market heating back up, right, there's competition to do deals, and that's allowing people to address the higher interest rates we're dealing with today and not have that become a problem until some point down the road.
Well, then you get the scary thing of private credit to compete with the banks all of a sudden has to make these concessions, not charge as high as fees. So are we in this environment where banks are coming back in, private credit has done an extend and pretend? When the music stops, what does that look like with a non-transparent and somewhat unknown entity?
So it looks completely different than what we went through almost 15 years ago, because at the end of the day, the people on the hook are investors. And I'm not saying that makes it okay, but if you think about who invests in private credit, it's pension funds, it's endowments and foundations, it's high net worth individuals. And so it would be unfortunate if all these funds had a problem and people began to lose their shirts. But people who try to draw parallels to what happened in 2008, I just think it's apples and oranges.
If you are just joining us, welcome to the program. A rare upside surprise on jobless claims about 10 minutes ago came in at 231. As we like to say on this program, the wrong kind of upside surprise on claims. 231 against an estimate of 212. Going into the opening bell about 50 minutes away, futures were negative. Then they turned positive, just about unchanged on the S&P 500. Yields were higher. Now they're lower. We're down 3 basis points on a 2-year at 480. In the FX market, the dollar was stronger. Flips weaker. The euro, 107.55. The euro now positive by 1/10%. Mike McKee said it straight out the gate. We haven't seen much of Mike because there hasn't been much data so far this week. This was the first data point. Tomorrow, we'll get Mitch, consumer sentiment expectations. Then, Mike, the big ones next week, PPI, CPI, US retail sales.
Yeah, we put it all into 1 week to make it more exciting. We're looking for a slowdown in inflation, and that's going to be the big story next week, and we'll be watching every day to see what Fed speakers have to say about that. Retail sales is very interesting. You got people who are all over the map on what's happening with sales. I got a lot of notes from people saying retail sales have slowed a lot. Bank of America out this morning saying that not only are retail sales holding in, they're not saying they're growing hugely, but they're holding in, but that they're seeing at the lower end of the income scale, which everybody's been talking about. The poorer people are all out of money, and so they can't spend anymore. That's not what Bank of America is seeing.
Let's talk about the setup. Can I just get into the setup for next week? Last week, we were talking about asymmetric risk. And what people were saying basically was that if the data's hot, yields won't rise too much because the Fed's not going to hike. But if the data's weak, yields can drop a whole lot more because this Fed wants to cut. That was when yields were at 5% on a 2-year. We're down to about 480. We've reset a little bit. Is there still asymmetric risk around this story into next week?
I think that there is, because if you look at the positioning data in particular, there is a massive short position sitting across the rates market today. And so I think part of why you saw rates come down so sharply in the wake of last week's non-farm payroll report was really just people adjusting to, okay, maybe the economy is getting a little bit cooler. Maybe we shouldn't be betting on going to 5. Maybe it's more reasonable to bet on going to 430 or 425. But to me, I always come back to where the MOVE index is, because it's important to think about volatility and what's being priced there. yes, we've come off the boil, but we're still at elevated levels. And what that represents to me is simply a wider dispersion of outcomes. You know, again, back to where we started the conversation at the top of the hour, last week had some for the bulls and some for the bears. And so I think we just need to see more data, particularly this CPI print next week, to get a better sense of the broader direction.
I'm trying to do what I can for both sides.
Very kind of you, Mike. Can I take that same sort of logic, though, and apply it to equities? It was Michael Hartnett who, before the jobs print, basically saying, if it's low enough, then it brings the stagflation fear. So in that way, bad news is bad news again. We got a lower print, we got a higher print for the jobless claims, yet equities, they're up. Are we not worried about that environment?
Eventually we will be, but I think we're still in the early innings of seeing the data really cool in the way that the market wants it to and the way that the Fed has been suggesting they would like to see it as well. We were chatting the other day. Yes, at some point here, bad news becomes bad news, but if you look relative to history, 175 payroll growth certainly isn't bad. 4% wage growth certainly isn't bad, and an unemployment rate below 4%, you know, that signals a pretty robust labor market situation.
David, you're going to stick with us. Listen to these numbers. Bank of America Institute numbers are just out. Take a listen to this. Lower income household balances were 67% higher than the 2019 average at the end of April. Middle income household balances 58% higher, and higher income households 45% higher compared to where we were back in 2019. Those numbers are absolutely staggering. More on that a little bit later. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. We're going to stick with real estate here because approximately 1 in 37 homes in the United States are now considered seriously underwater. Nationally, 2.7% of homes carried loan balances of at least 25% more than their market value in the first few months of the year, and that's up from 2.6% in the previous quarter. Kentucky, Mississippi, and Oklahoma saw the biggest increase in homes seriously underwater. And living in Manhattan is also getting more expensive. Apartment rents rose to a new high for April. Leases were signed at a median of $4,250, up $9 from the same time a year ago, according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. Rents have climbed annually in 3 of the past 4 months, suggesting another record-shattering summer to come. And shares of Airbnb are falling in pre-market trading. The company posted revenue that beat analyst estimates but provided lackluster guidance for a second consecutive quarter. The company, which specializes in shared homes and vacation rentals, says it sees growth before slowing an uptick in summer travel. It's expecting revenue growth to re-accelerate in the third quarter, though, as key international events like the Summer Olympics in Paris and the Euro Cup in Germany fueled travel demand. And that's your Bloomberg Brief, John.
Shonali, thank you. Appreciate the work this morning. Thank you very much. Up next on the program, back to the bundle.
The other positive for us is obviously the streaming service. We're encouraged by the progress we've made in that business in a relatively short period of time.
That conversation is coming up next. Just moments ago, jobless claims coming in at 231,000 against an estimate of 212. Your equity market recovering just about unchanged on the S&P. The opening bell, 45 minutes away.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We got jobless claims data moments ago. It came in at 231,000. The estimate was 212. That is an upside surprise, the wrong kind of upside surprise. And off the back of it, equities erased the morning's losses. We are just about unchanged on the S&P. Yields were higher. Now they're a little bit lower, down a basis point on a 10-year to 4.4845. Under surveillance this morning, it's back to the bundle.
The other positive for us is obviously the streaming service. We're encouraged by the progress we've made in that business in a relatively short period of time. We took prices up a little bit in the beginning of this year and didn't really see much of an impact. But we do believe that the great experiences we provide, people are willing to pay for.
So here's the latest. Disney and Warner Brothers Discovery announcing they will combine their streaming services into one bundle starting this summer. Subscribers will have access to Disney+, Hulu, and Max, both the ad-free and ad-supported versions. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, we've talked about this for years now. The bundle's making a comeback, and I guess here it is. What's the price point of this?
We don't know the price point just yet, John, but yeah, you're absolutely right. What was old is kind of new again, right? And it's all about now creating the super bundle. For Disney and Max, this kind of makes sense. I mean, both their products together will definitely have four-quadrant appeal. And I think, why we're seeing this, I mean, there is a kind of a hint of desperation here from all of these media companies, because we know that streaming subscriber growth has kind of hit a wall. I mean, Disney is not really able to get beyond that 150, 160 million subscriber mark. And then if you kind of look at Max, which has been fairly successful, they really struggled to get past that 100 million mark. So this is about kind of reinvigorating that subscriber growth, but more importantly, curbing churn. Because one thing with streaming that we know is it's really easy to cancel your service, and they're hoping that this way they can kind of keep customers on the bundle.
Geetha, as Danny mentioned earlier on this morning, it's not just this effort. We're seeing it in sports as well. As you look at the companies that are combining, what is bringing those specific companies together versus, say, tie-ups with others?
Yeah, so, this particular instance, John, with the Disney Warner Brothers is actually, I think it's perfect timing, because it's kind of a good setup. You mentioned sports. Both these companies, along with Fox, have that sports joint venture. So they do have a streaming product coming out a little bit later. They have now this Disney Plus Max product. Then they have the sports product. It kind of eventually sets up a path for them to have that super bundle, if you will. And I think that's kind of what they're aiming for here. And so far, what we've seen with bundling is that it does work. So Disney itself has said that about 40% of its streaming subscribers actually take the bundle right now. So that's, the Disney bundle with Disney Plus, with Hulu, and with ESPN Plus. So bundles do work. And that's kind of what they're betting on here.
What about the math of how it works for the company, Geetha? We learned that Warner Bros. Discovery wants to cut costs, wants to raise some of its subscription prices. What happens then if you need to offer a bundle and need to price it competitively to be the super bundle?
Yeah, I think they will. So this partnership here is a little bit different from what these companies have been pursuing. So what we've seen across up until this point has really been bundles more with the telecom providers. So we know that we had that big Verizon bundle where you had, Verizon was offering kind of the bundle with Max and Netflix. Multiple telcos, you had T-Mobile with Netflix. There's obviously a revenue share agreement here. Obviously, what these companies are trying to do is by doing it themselves without a telco partnership, they're obviously trying to keep more of that profit for themselves. But yes, ultimately, it is going to come down to cutting costs. And this helps them to kind of really cut down on marketing costs. Because if you look at just marketing costs for all of the streaming subscription services, apart from content, marketing and selling expenses are actually one of their biggest cost centers. So this really helps them with that when they kind of pool their resources together.
And that's actually a perfect segue into the question that I wanted to ask. We've talked about subscribers, we've talked about price, we've talked about costs, but content is king in this space. And so how competitive do you think this bundled content will be relative to the other folks that are in the market?
I think that's absolutely what they're betting on. You know, Disney obviously has its own appeal with younger children. HBO Max, as you know, is prestige TV. They're really, remember, you have a whole bunch of movies that are going to come on the service, as with Disney Plus, you know, once they release in theaters. And so that's really kind of what they're betting on here. I mean, you have two superpowers in terms of content IP, in terms of story brands. And so they're really kind of betting on getting, you know, those brands together and appealing to a much broader section of the audience.
Geetha, this was great. It's always great to catch up with you. Geetha Ranganathan there, Bloomberg Intelligence, on the latest streaming effort, trying to get our hands around just how strong this consumer is. I want to go back over those numbers from Bank of America and their Bank of America Institute research piece. Lower income household balances 67% higher than the 2019 average at the end of April. Middle income household balances of 58%. Higher income households of 45%. David, can we talk about this? Obviously, the month of April can be skewed by, say, tax returns. But where is this US consumer? It's something we grapple with every single day. Jobless claims tell you one thing. You look at overall payrolls growth, it tells you another. You hear from Disney and the theme park business, everything's fine. McDonald's, Starbucks, we got a problem. Where are we?
So I think that the consumer is in a period of transition, and you know, when we look at the broad swath of data that we have access to, you know, one of the things that you are seeing, particularly among lower income individuals, is trading down, right? So not buying the name brand of, say, paper towels or detergent, so on and so forth, but people are still very much valuing experiences, because it was experiences that were taken away from them during the pandemic. And so you're seeing a lot of spending continue, but the underlying profile of that spending has, in our view, shifted. I think what's particularly interesting about the lower income individuals, it all comes back to the labor market. You know, if you want a job in this economy, you can go out and get a job. And if you look at the data from the Atlanta Fed, as to where wage growth is most robust, it's still in those lower income buckets. And so these people, the cash is coming through the door. Given their higher marginal propensity to consume, they don't save it, they don't invest it, they go out and spend it. And that's what's keeping the whole thing humming along.
And not only is what they're putting it in changing, but also how they're doing it. Sure, they can get jobs, but at the same time, the pandemic savings has run out. John and I were talking about this earlier, buy now, pay later. A Harris poll found 43% of those who owe money to buy now, pay later said they were behind on payments. So as we get people shifting to this type of credit, sure, they're still spending for now, but when does the music stop?
So I think you're beginning to see that stress build, and I think it's all part of a broader story, and we talked about this a little bit earlier in terms of small businesses and floating rate debt, and that finally beginning to pinch. That you have seen delinquency rates on credit cards and auto loans rise here. You know, one of the things that came out of the great piece that you all put together on buy now, pay later was a lot of the folks that are engaged with those services also tend to have credit cards that are all kind of tied in together. And so you're seeing that leverage profile begin to build, and that's something that we're watching. You know, I think that the conversation is shifting here from, okay, you know, it looks like the economy may cool off. How much cooling are we going to see? And the big risk is if we see people continue to get over their skis, if you see consumers continue to lever up, if you see CEOs become increasingly confident and go for those capital expenditures, if you see vehicle sales, housing, right, the cyclical parts of the economy, if that begins to heat up, we're going to get a little bit nervous.
David, this was great. Just fantastic to have the hour with you. David Leibovitz there of JP Morgan. Bramo warned you at the start of the week. This week might be a little bit boring. Last 24 hours was 187.70 at the close on Tuesday, and then the close yesterday, 51.87.67. We've barely moved. Things are getting a little bit more interesting going into the weekend. Tomorrow morning, here's the lineup. Former House Speaker Kevin McCarthy will speak to Jim Bianco of Bianco Research, Anastasia Amoroso of iCapital, and Dan Suzuki of Richard Bernstein. Danny's going to be back tomorrow. We'll do it all again from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station. and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Granny. Welcome to the show. To underwhelm means you get a big penalty in the box. Airbnb, the bookings are down at the lowest pace since 2020. Will the summer peak drive higher? The stock is 8% lower, dragging a little bit on SPOOs. We've had a whip around in the jobless numbers. We'll count you down to the open and what it means in the data. Good morning. Coming up at the show, those initial jobless claims coming in hotter than expected, sending futures and treasuries off their lows, injecting fresh life to the rate cut debate. We begin with a big issue, looking for the next catalyst.
There's been a cocktail of bullish catalysts here recently. Getting to earnings season, buybacks, blackouts came off, and there was just a lot of, just temporary tailwinds here for equities that kind of propped us up. But I think we're facing some resistance here around some moving averages, and once the market comes to grips that the Fed is not ready to hike, especially not ready to ease, especially as we see CPI next week, which is expected to be fairly hot. I think we'll probably retrace a little bit to the downside.
Cocktail of bullish catalysts are set to fade. Are they? Katie Kaminsky of Alpha Simplex and Colin Martin of Charles Schwab are with me to debate that narrative. Katie, good morning. Are the bullish catalysts set to fade, and have equities yet to meet their reality check? Good morning.
Good morning. Yes. I mean, I think, sorry, I didn't understand that you were asking that question, but yeah, I mean, what we're seeing right now is a very bimodal positioning across different asset classes. You're seeing that equity signals are still holding ground, but if you look cross asset, fixed income signals continue to be short, and you're seeing some steepening in the yield curve. And you've also seen a tremendous rally in commodities in the recent months, something like oil prices. You've even seen food prices start to pivot recently as well in terms of the raw products like wheat, corn, soy. So you're seeing two different narratives, one that's saying sticky, higher for longer inflation, and then the equity markets trying to digest how serious is this for us. So hence the CPI is going to be really important next week.
Yeah, I think the debate on just how hot that is something we're going to work out. Colin, good morning to you. Bonds have had a recalibration, a little bit of a pip higher and a turnaround on these jobless numbers. But when you look at the bond market, do you think that momentum is running out of breath on the recalibration of a drop in yield?
I think it is. We think yields will probably remain range bound for a little bit until we get more evidence that the disinflationary trend will continue. We are seeing plenty of signals in other sorts of data that support the view that inflation should slow from here. But I think until we get more evidence in the actual numbers, so like next week CPI in the PCE numbers, and not just next week, but over the next month or two or three, I think until then, and until we get evidence that cuts are coming soon, we might see yields trade in this range. We think over time they should move lower, but until we get that disinflationary catalyst, they might remain range bound.
Yeah, all eyes down for next week. It's going to be fairly definitive on additional information on the inflation front. We've just had some data this morning. Let's catch up with Mike McKee. He's side by side with me here. So the jobless claims 231, Mike. We're going into a 30-year government auction, and not to be outdone, you've got a little bit more data coming tomorrow. Good morning.
Good morning. Well, there is a lot of concern about whether the U.S. economy is slowing or not, and the jobless claims would seem to suggest that. You look at the initial claims, 231, as you mentioned, running well above the year-to-date average last week. Continuing claims are just about at the year-to-date average. They were up as well. Is this a sign that the economy is slowing, the labor market is loosening, and we might face recession down the road? No. And here's why. You take a look at what's been happening with jobless claims, and you go into the history of it. And it's a little hard to read on this because obviously 2020 skewed everything. But you can see the green line is the average of jobless claims over about 50 years. And yes, jobless claims rise when you go into recessions. And we're not rising right now. We've gone up just a little bit, but you can see how far that white line is below the average still, even at 231. So what happened? New York school kids went on vacation the last 10 days of the month of April. So the first week in May, which is what the numbers are counting today, show that all the people who are eligible in the school system to file for unemployment did so. Expect a drop back next week. What does it mean for the Fed? Well, nothing there, but their attitude is pretty much all the same. Everyone's singing from the same songbook, including Susan Collins from Boston yesterday, saying the recent data lead me to believe this will take more time than previously thought. That is probably the case, so we kind of put that aside, except for the fact that the Fed on hold is a problem for the rest of the world. And I go back to the old saying about it's our dollar, it's your problem. And it is a problem for everybody else. You can see I normalized the changes here. Currencies, the pound, the euro, and the yen inverted there, have been dropping because the Fed's been raising rates, and you get more money and more interest in the United States than other places. We saw that today. Bank of England on hold, but everybody thinks they might cut, so the pound goes down. And at this point, this is a problem for those countries, but it also starts to be a problem for us. If we continue to have problems selling exports overseas, it's going to hurt the manufacturing numbers that we might have seen a little bit of in the ISM last week.
Nobody wants to challenge that strong dollar policy, do they, Mike? Let's see until it bites in the proverbial. Now, you mentioned the Bank of England, Mike, so it's worth just checking in some of those cross assets this morning. You've got sterling back to flat 124.95. The Bank of England Governor Bailey, who we'll sit down with a little bit later on, he's optimistic that things are moving in the right direction. A rate cut in June is neither ruled or planned, and there was a bit of a shift. The Deputy Governor inside the Bank of England moves and joins the external member, calling for an immediate cut. So the narrative is building on that. Euro slightly better bid against sterling, and 10-year yields flat at the moment, but a great deal of the dovishness was already in the price. Katie Kaminsky and Colin Martin are my guests this morning. To the global aspect of this, there's the Bank of England sounding more dovish. The Riksbank cut. The ECB are presumed to cut earlier. We are moving towards a global rate resetting narrative, Katie. How important is that for overall growth momentum to sustain? Because it does all feed back and wash back into the US at some stage.
Yes, and I mean, I think it's important you bring this up. And if you look at those economies that have already started to push more towards cuts, they're seeing less growth than what we're seeing in the US. And that's why there's definitely a much more tricky picture, and it might take a little bit longer for the US to be able to cut rates. The market wants it. I think the Fed wants it. But in general, the data hasn't shown yet. We also point out, if you look at countries like the UK and Sweden, example, they have a lot of floating rate mortgages. So they have definitely seen a bigger impact in their housing sector than we have seen in the US. So I think there's just differences across these countries where, in terms of how quickly they're going to be able to normalize rates.
Look, absolutely. And the argument is here in the United States, everybody, not everybody, but a great many people went through the remortgaging process at those lower rates. Colin, you know, the Fed could be the last central bank standing, the last hawk standing. And that has got consequences on differential trades, on treasury bonds, on treasury against other government bonds, and also for the dollar as well.
Yeah, that's right. If we look at the global bond landscape, the gap between U.S. yields and global bond yields has rewidened recently, and I think that's one thing that could keep a lid on our yields should we get some upside economic surprises where there might be some foreign buying, especially if we get closer to those 5% levels on intermediate and long-term bonds. I think that's a psychological level that a lot of investors are interested in. So I think that's important. Going back to your comments about the dollar has been strong. We saw it drop a little bit this morning with the initial jobless claims number, but there can be benefits to that in terms of inflation, where it does negatively impact exports, but it can positively impact imports. And we know that we're trying to bring inflation down, and the stronger dollar can help that to a degree in terms of import prices.
Colin, just before we move on, what is it that retests 5% in the 10-year government bond yields? Because we've had, as I say, this recalibration. It's my favorite word at the moment. But what is it that spooks me back to 5% on 10s?
Well, I want to make it clear, it doesn't spook us. We don't think it's happening. But what could happen if the economy were to not just remain as resilient as it is, but really reaccelerate, and then we'd likely need to see a reacceleration in inflation, even just modestly, which would reprice expectations for the Fed to not just be a higher for longer policy, but actually start to see more rate hikes coming down the pipeline. Doesn't seem likely right now. Most Fed officials, with the exception of one or two, have generally pushed back against that. Markets don't really believe that. So as long as the next move is expected to be a cut, we don't really see long-term yields really getting back to that 5% area.
And Katie, for you, I mean, as Colin says, look, that's not his base case scenario. When you take the narrative, it is that they want to cut. They just want more time to understand, to recalibrate, to be cautious, to let it be bumpy. As you look at the equity market landscape, we've had a lovely run. We've had this slight pause. So what is it that would get you to deploy more into equity before rate cuts?
Oh, that's a really good question, because frankly, we've seen such a big move that we need to kind of see resilience. We need to see that we can waver through this. So we need to see good earnings. We also need to see relatively resilient labor data. We need to see that things are still sort of safe and we have a way to navigate through higher for longer, such that we're not seeing deteriorating financial conditions. Right now, it's still looking relatively bullish on equities, but whether or not you're thinking about entering, it's got to be something to make you pause, given exactly what Colin said. I mean, just thinking about the fact that you could start to see a steepening in the yield curve. We have seen a little bit of that recently. And so I think that has made people a little concerned that, this inflation narrative could be even stickier than they would like. And thus, it's harder to navigate for equities, making that more questionable.
And yet, without sort of putting you into the box of talking about specifics, I look at overnight what has happened with Airbnb. That's consumer. Uber, that's also pressure. Disney, subscriber numbers, parks were resilient. But at Starbucks, at McDonald's, there are, if you underwhelm, if you underperform, if you underdeliver, you really are getting a pretty big pressure pushback from the market, aren't you, Katie?
Yes, I would agree. I mean, if the consumer starts to waver even more, that would definitely be something to be concerned about. That would eventually trickle into growth and will affect company earnings. And then you'll also see more sort of ammunition for the Fed to actually act So I guess that would be something that might be pro rate cuts sooner. So I think it's bad news is good news on the consumer side, but hopefully we don't have that.
We're always trying to sort of find out where the next risk is, whether it's systemic or idiosyncratic. I'm just wondering, we wrote the big take, not me, but the team here at Bloomberg, and it was about the phantom debt, the buy now, pay later, and anybody who's lived through 2008 on the mortgage crisis, anybody who's lived through 2000 in terms of the dot-com bust. Colin, what did you make of the buy now, pay later? I mean, the Fed doesn't seem to be too worried about private credit and those kind of areas, but buy now, pay later, some of the numbers are quite chunky.
Yeah, I saw that article yesterday, and what I guess makes me a little bit nervous is that we don't have a full picture of what's going on underneath the surface. So if it is, in fact, a really large amount of debt that's out there that we're not seeing in terms of what consumer credit looks like, then that would be a risk. You know, what I think is a good thing, if we look at the data that is available, we did get consumer credit earlier this week, and it rose at a pretty small amount, especially with credit cards and that type of revolving debt. And I think that's a good thing, because if we look at what's been powering the economy lately, the consumer remains strong, consumption remains strong. But if we do see a slowdown in credit growth, I think that's a good thing and more good news for a potential soft landing.
I think the number here, I've just opened the story, $700 billion globally by 2028. And that's all grand if you're in a job and you're earning a solid level of remuneration. And of course, on a repurposed mortgage at about 2%. Life is sweet. Katie, thank you very much. Katie Kaminsky and Colin Martin, my guest this morning on The Market. Let's look under the hood ahead of the opening bell. Abigail Doolittle is with me side by side.
And let's have a look at that one stock that you were mentioning, well, several stocks you were mentioning, but one of them being Airbnb, shares down sharply, heading to the worst day in more than a year. This, of course, after the guide was underwhelming for a second quarter in a row. Weaker demand as revenge travel fades. They are projecting the slowest growth since late 2020. As for some other movers on earnings, ARM, the chip holding company, beat, but the guide was viewed as a little light. Folks wanted a bigger boost given the AI component. Also fears that maybe there's some sort of an AI slowdown on this. The stock down 6%, but it should be noted up 40% into this report on the year. Roblox plunging, a record decline, heading to a record decline, down 25% in the pre-market. The online games and entertainment company is plunging on their weak second quarter outlook. But there is one winner here, and that is Bumble, up 12%, a huge first quarter beat. They also reaffirmed the full year guide. Now the stock into this report, man, is down 30% on the year. There is also a 13% short interest. So I think that some of this move higher for Bumble in the pre-market and perhaps on the open has to do with the short squeeze.
Okay, nothing to do with love lives eternal. Abby, thank you very much. Abigail Doolittle there with the very latest on stocks. Coming up, President Biden, he warns on Israel.
I've made it clear to Bibi and the war cabinet, they're not going to get our support if in fact they go in these population centers.
The conversation is still ahead on Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience. But are you hopeful that I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
They go into Rafah. I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks. But I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go in these population centers.
A stern warning from President Biden to Israel. The remarks came as the U.S. paused the delivery of over 3,000 bombs to Israel. The White House is concerned over the damage that they would do to the city of Rafah. Israel's finance minister responding to Biden saying, quote, "We simply have no choice as this war is an existential one, and anything other than complete victory will put the existence of the Jewish state in danger." Amory Hordairn joins me now from Washington. Amory, I look at this statement from the Israeli side. I look at the Defense Secretary, Lloyd Austin, saying at Congress testimony yesterday, there have been too many casualties in this battle space. Here we are with an escalation from rhetoric and pulling back on some bombs that the United States were going to deliver yesterday. So this is a shift, the gravity of the shift from the White House. Good morning.
Good morning, Madison. I spoke to Ed Mills earlier this morning from Raymond James, and he was talking about the fact that this is as close to a red line as Biden has been. One of his most vocal warnings on Israel in this interview yesterday evening. When we were talking about this yesterday, we really were talking about a pause and that no decision had been made at the White House. But then following this interview, it does look like that pause is almost definitive when it comes to whether or not these bombs would be going to Israel. Biden has been concerned, and he talked about this, about the civilians that have been killed, Palestinian civilians that have been killed in Gaza. And what is so concerning to the administration, of course, is how densely packed Rafah is with more than 1 million Palestinians there. There's also, of course, which we talked to Ed Mills about as well this morning, and he pointed to the fact that we are 6 months out from the U.S. presidential election in November, and there's been a tremendous amount of domestic political pressure, especially from the youth. We've seen this across the country at college campuses, on this administration to take more of a defiant tone when it comes to the Netanyahu government. We should also note, Manis, that yes, this is potentially a fracture in the relationship, but we have been here before in the past. There is historical context for this. It is rare to see this kind of break, but it's not unprecedented. We saw it with Obama, we saw it with Reagan, with Nixon, with H.W. Bush, and that is where this relationship is right now. But Biden, this warning was very clear yesterday. Israel will not be getting those bombs.
How much of this pressure, Anne-Marie, is because of the college campuses? You go back to the apartheid era, which is where that level of social unrest in youth, protest against apartheid, was brought to bear by divesting from South Africa. Many people are drawing comparisons with that for Biden. He's under pressure. We're running up to this election. The youth are important. To what extent is the domestic imagery pressuring Biden to exert more force on Bibi?
Well, I think there's just really a divide with some members of the Democratic Party, especially when you look at the progressive left. A lot of that is the youth vote, but also even outside the youth vote, even some concerns with Democratic senators, as well as clearly with a lot of some congressmen and women on the Democratic side that want to see more restraint when it comes to Netanyahu and how they are going after Hamas in Gaza. So there's been a lot of political pressure within Biden's own party, which is why this has been so challenging. Because in that same interview, he talked about how it is important to secure Israel, how it's important to make sure that they have the Iron Dome. He's talked about his ironclad support to Israel, but at the same time, he's also talking about not sending them some of the ammunition that the Israelis say they would need. And we haven't heard from Netanyahu directly, but I think members of the War Cabinet have made very clear their displeasure with this. This is the tricky line Biden is walking, and until this is resolved in Gaza, this is going to be the tricky line Biden will be walking until November, Manis.
Indeed. Anne-Marie, how would you describe the nuances? There's been daily, sometimes over a series of weeks, conversations between Bibi and Biden. A lot of people question the ability of this administration to exert real force. They say if somebody else was in the White House, it may be a different scenario. Does that narrative hold? And to what extent is America still got the ear of Netanyahu? Or is that power and that influence seriously waning? And that's what's being said internationally rather than domestically.
I think what you see is that there's been a growing divide, especially since October 7th, when we saw this terrorist attack by Hamas in Israel. Biden flew to Israel, embraced Netanyahu. They were talking almost daily, then weekly. And now those conversations, even though there recently was one between Netanyahu and Biden, those conversations have become a little bit more sparse. What we do see, though, is that Bill Burns, the head of the CIA, is still in the region. And something the U.S. is trying to exert and trying to potentially even maybe use what's happening with this weapons suspension is they would like to see a ceasefire negotiation come to fruition. And at the moment, they are still committed to that when you have the head of the CIA remaining in the region to try to work this out. He met with Netanyahu, Ron Dermer, and other Israeli officials yesterday, and I believe today he'll be in Cairo to continue those negotiations.
Okay, Anne-Marie, let's see where this story evolves to. Anne-Marie Hordern in Washington. Coming up, your morning calls, and a little bit later, Jay Pawlowski of TPW Advisory joins me after the opening bell.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Let's get you up to speed with your morning calls from Wall Street. First up, Deutsche Bank lowers the price targets on electronic arts to $150. The firm keeps a hold rating on EA, saying that the company's multi-year guidance shows margin potential. Next up, Accountability Research raises the recommendation on Shopify to a hold. The online retailer yesterday reporting earnings that topped estimates. And finally, Raymond James upgrading Cheesecake Factory to outperform, saying the results were strong despite the softening trends in the industry. Nothing beats a chunk of cheesecake. We're going to catch up with TPW's Jay Pawlowski. That's next after the opening bell.
just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
DOJ or other authorities
could face bigger challenges elected.
Was going to keep real World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond. Since we had the jobless claims, and we've trimmed our losses as that number pops a little bit higher. We can argue as to whether it was idiosyncratic and to do with the holidays and people claiming jobless claims. Right now, we're back to flat. 52.12 is where we stand. And on the NASDAQ, keep an eye on Airbnb. It's been a real drag on this market, but we'll take you through that story in just a moment. In terms of the rest of the markets, cable is back to flat as we see a dovish tilt really from the Bank of England as the Deputy Governor goes on site calling for a cut. How much of that was already in the price? The dollar still remains fairly resilient. 10-year yields virtually unchanged, 450. We've got a 30-year government bond auction coming down the pike today, $25 billion worth of an auction. And there was a tepid demand for 10s yesterday. 2.49 was the bid to cover ratio. Crude ticks up by 0.25%. So some stocks that we're keeping a close eye on. Beyond Meat, despite the price hikes, the plant-based company, margins came under pressure from higher manufacturing and material costs. A classic story. Abby has the detail.
And on this, we have investors pretty rattled. The stock down 9% in the pre-market, down 14% at that point, the worst day in about a year. So investors not liking this report where they essentially missed estimates for the first quarter, EBITDA coming in a little bit light. On the other hand, what's interesting here is that they did actually maintain the full year guide. So there's a greater than 30% bearish short interest on this stock, suggesting that maybe some of those bears taking the idea from some of the analysts that it's not clear what's ahead. In fact, we have William Blair saying that they cut their 2024 EBITDA estimates to reflect that softer gross margin you were talking about, and that it's uncertain where this is going to lead them over time. But again, Manus, they did actually maintain the full year guide. And some analysts, other analysts, including Jen Bartashis here at Bloomberg Intelligence, saying that their resets in various geographies and culling of different products may actually be an encouraging sign. So it seems as though there is a bull-bear debate on this stock, but right now the bears have it down 12%. Again, I would note that there's a massive bearish short interest on this stock. Probably a lot of this, those bears pouncing.
Abby, thank you very much. Let's turn over to travel. Airbnb, as I say, giving lackluster guidance for the second straight quarter. On week outlook ahead of the summer season. Will that save them? Alex Semenova. For now, the market is not happy. Good morning.
Good morning, Manus. Yet another instance this earnings season of a company beating on earnings but disappointing on guidance, and investors really punishing the stock for that. Shares of Airbnb are down about 6% this morning. That's the worst since October. This is even as it doubled net income from the year-ago period and beat on earnings per share for the quarter. That outlook, though, indicated that growth in travel is slowing ahead of the peak summer season. Airbnb projects expected revenue in the second quarter between $2.68 billion and $2.74 billion. Analysts on Wall Street had expected the higher end of that range. Evercore ISI said revenue and adjusted EBITDA were bright spots in the report, but revenue forecasts bracketed the street. And in its statement, Airbnb blamed the earlier timing of the Easter holiday this year, as well as currency headwinds for this disappointing outlook. Airbnb and its rivals, of course, have been trying to reach a new normal after the COVID-19 pandemic, but the recovery has been really choppy, with growth recovering in some regions while tapering off in others. Last week, Booking Holdings gave a worse than expected outlook, and Expedia Group disappointed on earnings as well. Manus.
Alex, thank you very much. Alex Semenova there. On fintech, Robinhood reporting a second straight quarterly profit as higher interest rates and cryptocurrency trading fueled the revenue growth. Katie Greifeld has the details.
Well, like you said, a second straight quarterly profit. Also, Robinhood beating and posting records on a number of different metrics. Let's go through some of the numbers right now. Net income for the first quarter, that totaled $157 million, or 18 cents a share. For context, analysts had been looking for 6 cents, so a big beat there. And you take a look at a year earlier, actually, that was a loss of $511 million, so a big turnaround there. When it comes to revenue, net revenue climbed 40% to $618 million, and cryptocurrencies revenues there surged 232% to $126 million. And when it comes to cryptocurrencies, remember, of course, earlier this week, you had Robinhood saying that they received a Wells notice from the SEC warning that the firm faces enforcement action over its crypto business. So a potential concern there, but you certainly don't see it in the stock this morning. Currently higher by about 8.5%. And going into these numbers, the stock had been higher by about 40% year to date. So really building on that momentum today, Manus.
Okay, Katie, thank you very much. Stock rocking and rolling there. On the consumer space, Tapestry cut its full year revenue outlook after sales decline in North America signaled weak demand. Isabel Lee has the latest on the retail narrative. Isabel, what's the story?
Hey, Matt, shares are edging lower by 3%. So Tapestry is the parent company of many brands we know, including Kate Spade, Coach, and Stuart Weitzman. And the company cut its revenue forecast and trimmed its full-year forecast to $6.6 billion. That's well below estimates. Revenue also fell more than expected, dragged down by sales from Kate Spade and Stuart Weitzman, which just really struggled to gain consumer traction, especially when it comes to their accessories line. We have revenue at Kate Spade falling 6% and revenue in Stuart Weitzman falling around 18%. Over at Coach, things are a little bit better because revenue is flat. Sales at the company, its average prices of handbags, which is a metric closely watched by investors because this is a revenue driver, was up. So at least there's that tinge of good news. But overall sales in North America and China are down. And for now, shares are really edging lower by 3%. Year to date, the stock has gained, though, around 5%, but still underperforming the S&P 500, Manus.
Isabel, thank you very much. Our next guest writes this. We're in the early stages of an earnings upcycle, and that will support global equities and note double-digit EPS growth forecast for the U.S. equities this year and next. It is Jay Pawlowski, CIO, co-founder of TPW. Jay, good to have you with me. Look, it's great to have that kind of an outlook, but if you miss, or remotely miss, Intel, underwhelming, under the midpoint, Uber, underperforms, Starbucks, Airbnb, I mean, if you miss at all, there's severe penalties. Are you still as convicted on the earnings outlook after the sprinkling that we've had over the past 5-6 days?
Yeah, Manus, you make a good point, and great to be with you. And I think it's important to note that your point actually reaffirms the idea that we're not in some sort of bubble, right? We actually have a market that is discerning between winners and losers, and that's actually a good thing. And when you gross it up and look at the market as a whole, 81% of companies reporting to date have beaten estimates. That's much higher than normal. Usually that beat is around 70%. And even more importantly, if you look at the next 12 months earnings expectations, they are rising. And in fact, last week, you had the biggest jump in next 12-month earning forecast in the last 3 years. And so analysts listening to companies are guiding and raising their estimates higher. And so when you have earnings estimates going up, and you have stock buybacks, by the way, running at about a 15% year-over-year increase, stocks are not going to go down.
I like what you say there, which is, you know, there's resilience. We're not in a bubble. The credit card spending, I'll come back to that in a moment. The Bank of America report, very, very strong consumer spending. So maybe it is in individual stocks we are becoming more discerning. But I love what you say about the Mag 7, and this is it. The penny dropped during several of the Mag 7 reports. Massive spending plans, roughly $45 billion apiece for Alphabet and Meta, and a strategy of spend like crazy now to monetize like crazy later. And it really does personify, you know, how Microsoft and Alphabet were rewarded. Meta asked for patience and they were lambasted. When you say that we're not in a bubble, how would you define where we are in Mag 7, which is a critically important part of the overall equity narrative?
Yeah, I mean, I think Mag 7 is pointing the way to kind of a winner-take-all, big moat type environment in the tech space. And so we're really focused, actually, though, Manus, on the idea that we're entering an age of investment, right? You look at those Mag 7 reports, they're talking about in spending, cap spending next year of 45 to 50 billion. AI is absolutely critical, right? Every country, every sovereign country needs their own AI. Yeah. Every AI requires lots of semiconductors. So we want to own what we call the picks and shovels in this space, and that's primarily in the digital space. That's the semiconductor stocks. And then, interestingly, and this is happening super fast. I've been in this business a long time, and the speed at which things are moving is just really incredible. And we're fusing the digital space with the physical space through the demand for power. And so we think we're setting up for shortages in things like copper, because we're expanding the digital space much more rapidly than you can possibly expand a physical copper mine. And so we want to own the picks and shovels in both the digital space, that's the semiconductor stocks, and in the physical space, and that's the miners. So copper miners, uranium miners, we think there's a tremendous opportunity. And so you mentioned credit card spending. We have fully employed consumers spending, driving consumption, and we have an age of investment fueled by cash-rich companies and governments who are ready and willing and understand the necessity to spend on things like AI and climate. And that is a very robust outlook for the global economy, underpinning our view that we're in the early stages of a multi-year blue sky period for the global economy.
I mean, that's not just Goldilocks on her own having a good hearty breakfast of a bowl of porridge. That is the whole world coming to feast. I want to dig into this. I'm a believer. You've sold it to me. I want to dig into this Bank of America report. They talk about consumer spending being at 1% year over year. This is in April. Take out some of the noise of Easter and one thing and another. That is following a rise of 0.3%. So we're on the extend and pretend. We're putting it on the old plastic. Lower income spending remains above higher income households. That's probably a classic. But this consumer is strong. Consumer is spending. But is there anything worrying in that? In that consumer spending on credit is rising? Is it the last breath of the consumer, or is it, don't worry, they've got jobs, they're being well paid, and you're being overly zealous, you're being overly negative on a read on this spike in credit card spending?
Yeah, I would take the former versus the latter. I think this is not really a big issue. Household net worth is off the charts, right? Record stock prices, record housing prices, fully employed consumers, real wages growing after inflation. You look at the Atlanta Fed nowcast for Q2, just came out yesterday, 4.2%, Manus. 4.2%. Consensus for Q2 is 2%. Okay, so you're talking double. Now, we know that nowcast moves around very much, and we're not saying that's a set in stone number. What we are saying, though, is there's no sign that that there's going to be a massive round of layoffs, right? You have that demand side picking up. That's now driving through inventory restocking to the production side, the manufacturing side. And we wrote in our latest monthly, which you've quoted very generously, about a manufacturing revival on a global basis, actually using the same Bank of America source for that work. And so we're we're not concerned. The liabilities versus household net worth is actually at a very low number on a historical basis.
I would just give the qualification, just to make sure that I'm representing Bank of America fairly, is that the lower income households, after tax wages, which plays to what you said, salary growth has risen while the savings buffers remain. So even though we talk about the post-pandemic savings numbers dwindling, there's something different in these numbers. If I take that entire sweet spot that you've just painted for me, then maybe we're not restrictive enough and maybe we need a hike.
No, I think, look, the Fed took the hikes off the table, and that's the right approach. We're in a global rate cutting cycle.
We are.
You just saw the Bank of Sweden cut, so the G10, the big developed economies are starting to cut. That goes along with the emerging markets that are starting to cut. And it actually raises a key point for us, Manus, and that is we're starting to sniff out signs of a change in global equity leadership. And I'll just point out that ACWI ex-US, emerging markets, amazingly enough, and Europe have all hit new 52-week highs in the last week, while the S&P remains 1 to 2% below its 52-week high. And so we're watching the dollar very carefully here when you talk about rate cuts and rate hikes. We're watching the dollar very carefully. We think the dollar is ripe for a rollover, for a decline, and we think it could be like a momentum type decline, as you've seen in markets around the world, commodities, et cetera. And so if that is true, that would reinforce this idea that emerging markets led by China, of all places, is actually starting to pick up the baton and provide global equity leadership, which has not been the case, for more than a decade. That would be a major, major sea change for global investors.
Okay, preparing for that rotation. It's already happened, as you say, with Europe and with emerging markets. It's whether that accelerates. Jay, thank you so much for being with us this morning. Jay Pawlowski of TPW Advisory. My guest this morning on the markets. We've talked about Airbnb. Are you booking? Will the earnings signal a slowdown in the consumer?
We're not feeling a lot of consumer pullback. I think our forecast is travel will be solid. As I said, just a slightly decelerating environment.
The conversation next on Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We're pretty confident travel is going to remain strong. There may be some trades as consumers trade out certain things, but there's lots of ways to make their dollars go farther if they're focused, if they come to the right place. And so we feel really good about that positioning. And we're not feeling a lot of consumer pullback. You know, I think our forecast is travel will be solid. As I said, just a slightly decelerating environment.
As the view from the Expedia CEO shrugging off the concerns about the consumer. This as Airbnb raise new red flags. Well, the company posted disappointing outlook, suggesting a slowdown in travel demand before the peak summer season. Is that what really is behind the story? Mandeep Singh is from Bloomberg Intelligence. Mandeep, you know, the data in itself shows a little bit of a lull before the summer spike, but you would say it's possibly a little bit more about saturation and maturity of the product, is it?
I think so, and given, you know, how big of a bump we saw with Airbnb during the pandemic, I mean, remember longer duration stays, people were staying more than a month, sometimes 6 months at Airbnbs during the pandemic. So they got that bump, you know, in terms of their core room night book. And that is the metric that seems to be decelerating, even though they're doing a lot of things on the product side. I mean, Brian Chesky emphasized a number of new product initiatives, but nothing seems to be moving the needle at the scale where they're at. They may be actually close to 500 million room nights by next year. So that's a pretty big number when you think about, you know, their category leadership position in alternative accommodations.
Tell me this, does it need AI to really move the dial? What is AI in Airbnb?
Well, so Brian talked about using an AI agent to book your travel. I mean, think of how we interact with the apps and websites. We go and punch in all the data, do our searches. What if there was a fancier way to engage with an AI agent that could do this?
I'd appreciate it. It would help me get through all the various filters a lot more quickly.
And so on the product side, they seem to be doing a lot of things. It's just, it doesn't show up in that top line growth yet. And that's what market wants to see.
Yeah, the market is hungry for delivery on time. Mandeep, thank you very much. Mandeep Singh. Now, there's another stock that we're watching. It is Warner Brothers Discovery. The company reporting sales and profit that fell short of the expectations due to low TV ad sales and poor performance at the movies. Geeta Raghunathan is tracking the story. So Warner put it in a resilient front this morning. But Geeta, talk me through the background.
Yeah, so with Warner, Amanda, so this kind of really epitomizes everything that we're seeing in media right now. So you have the TV networks business, which brings in about 50% of the revenue. But remember, that's 85% of profits. And as you just said, TV advertising is in a very, very tough spot. We saw TV advertising decline about 11%. That caused about a 19% decline in EBITDA. The good thing, though, for Warner is that they are showing some good momentum in the streaming business. Remember, this is the storied HBO Max product, so they had some subscriber gains. They're showing some positive profits, and this is the new guideline metric that is kind of very, very important. So it looks like they can get to profitability there. The only problem is that the streaming progress is not going to be enough to offset the decline in the TV network business. And the other big thing that we're kind of watching for with Warner is this pending NBA deal negotiation. So they currently have a deal with the NBA. They're supposed to renew it, but they might lose it out to NBC. And that, again, kind of puts their TV network business in peril.
Yeah, that could be a flesh wound. Geeta, we'll track that story. Geeta Raghunathan there. Some sector price action for you before we go. Abby is with me side by side.
Yes, in fact, let's take a look at the sectors. We have the S&P 500 up slightly right now, up about 0.1%, but it is a broad-based gain, as small as it may be. Now, to the downside, on the other hand, we have some laggards, tech, but down just 0.2%, and the other three sectors that are lower also by very small amounts. To the upside, we have real estate, energy, healthcare, consumer staples. That real estate really doing quite well, up 1.5% on the morning. This as yields are a bit mixed, so it gives a little bit of a reprieve to those dividends. Now, let's take a look at another dividend-rich sector. That is the utility sector. Right now on pace for a 7th up day in a row, the longest winning streak just since April 25th, and that's because this stock or this sector over the last 4 weeks higher. This is the first 4-week winning streak for the utilities index, Manus, going all the way back to 2022. Now, some see this as a defensive move because it is a defensive sector, especially given the fact that you have it rising as yields are rising. That is an interesting message. Typically, these stocks would not do better as yields rise because those dividends look less well. So again, some are saying that this is maybe some sort of a defensive shot across the bow of some weakness ahead. But on the week, I believe we have the S&P 500 higher. So an interesting mixed message there.
Abby, thank you very much. Coming up the show, we'll set your watch for you, your trading diary. Up next on Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Jobless claims pop a little bit higher. Was it an anomaly or something more malevolent? Either way, yields drop. We're off the lows of the day. Stocks are struggling. Narratives from companies like Airbnb. Is that really about saturation? Right now, NASDAQ down by 0.2%. So we're treading water. We've got a pretty sizable auction coming through on the 30-year government bonds. We've got $25 billion worth of government bonds coming through. This is how the rest of your week looks like. San Francisco, Fed's head Mary Daly led it today, plus more bond sales, as I say, this afternoon. Rolling through to the University of Michigan Consumer Sentiment, that is tomorrow. Fed speak from Bowman, Goolsbee, and Barr. And finally, the monthly U.S. federal budget. That was countdown to the open. The rest of the team will take you through your trading day. From New York, a very good morning.
look at the number of women that want to learn the game, young girls that are joining on the tee, really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday Eve. I don't know about you guys, but I was really feeling it today. So if I'm feeling it, you're feeling it. We will get through this day together. I'm Alex Steele. Paul Sweeney is off today. The wonderful Molly Smith is joining me for the next 2 hours. We're going to cover all the top stories. It's really tech and space and sports. Let's be honest.
I mean, this is the news of the day. As we said coming in here, I had a dream about us hosting last night.
She did.
So I'm not sure. I think that is just the news of the day.
That's what I said.
I know, right?
Is it a dream or?
But apparently
it is a dream. Look at the two of us.
But apparently the dream was just that I was wearing a maroon shirt. And
I also was, and then I didn't
am
wear it
wearing
today.
a maroon shirt. So I don't know what this means, but this means something. And we're going to talk about this, apparently, with all of our guests. Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, will be joining us. Niraj Patel, Bloomberg Intelligence Senior Software Analyst. We're going to discuss HubSpot plus Alphabet equals ? We'll get that to you as well. Plus Mark Gurman, Bloomberg Chief Correspondent on Global Technology, will join us to discuss Apple's succession plans. Do they have one? I don't know. But let's get the latest now, Bloomberg Business Flash, with John Tucker, who's also not wearing maroon, just so we're clear for our radio audience.
Not my color. This report being brought to you by Interactive Brokers. Interactive Brokers charging U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. Right now, 8 of the 11 major industry groups in the S&P 500, they're pushing higher, being led by real estate and energy. Information technology, that is the biggest drag, and that's home to NVIDIA shares. They are down 1.6%. On the data front, we're seeing gradual cooling in the labor market. The number of people filing first-time claims for unemployment rising to the highest level since August in the latest week. Initial claims increasing 22,000. Could increase the odds of an interest rate cut for the Fed. David Leibovitz at J.P. Morgan sees the markets this way.
The market is clearly getting a little bit twitchy about this very robust pace of nominal growth. And the issue is you're getting the earnings coming through, but you're capped on multiples given the subsequent outlook for rates. And so I actually think a little bit of softening in economic activity, maybe getting the Fed to acknowledge that easier policy really is on the horizon, that could be the ideal scenario.
And on the yield front, 2 years, 1 basis point lower. That's at 4.82. The 10-year yield, not a great auction yesterday, up 1 basis point. That is at 4.50 right now. Overall, the S&P 500 4 points higher at 51.92 on the index. The Dow Jones Industrial Average up 81 points. And the NASDAQ 100 right now 19 points lower. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Molly and Alex.
Thank you so much, John Tucker. I'm not going to lie to you guys. There's not that much happening.
It's really not. I mean, that's why we're talking about my dream last night. We were talking about John wearing a vest today.
We're going to talk about fashion. So unlike Tom Keene, who has the amazing ability to make a mountain out of a molehill, I cannot do that. I don't have that ability. I will tell you there are individual stocks that are moving that we get to talk about, like Roblox, which is really cool. Are you a Roblox user?
I'm not, but I think Nora Melinda, who's going to join us next, might know maybe a thing or two more about it. Perhaps.
Do you? Nora
if it's
Melinda?
on the move?
Not as much as I'd like to know.
No. Okay, so you guys are all young and stuff.
We should know these things, right?
You should know the Roblox
Nora's
stuff.
younger than me.
Okay, but what are you watching? There's a lot of other stuff that's moving too, like Airbnb, for example.
Yes, I'm watching Airbnb. So the company is actually lower this morning, so much as 7.8% of a drop. That's the most in nearly a year. And this is after it reported a dull guidance for a second straight quarter. It forecasts that revenue for the current quarter will be between $2.68 billion to $2.74 billion, but the average analyst estimate had been hoping for the upper end of $2.74 billion, so falling short there. And it did note that Easter, coming in March this year rather than April, was a bit of a drag on its key metrics. And it says that travel spending will slow ahead of its peak summer season. And analysts and investors are not too thrilled to hear this news here.
No, it's a bit, it does pair with like the Expedia and the booking that we got, right? Like the numbers, basically consumer demand for stuff is slowing a little bit. What that looks like, if it's normalization or a real slowing, I feel like is the question.
Exactly, and they're being very picky about where they want to use their discretionary funding, especially when we think back to Live Nation and, the stock popping on the news that people are really interested in concerts. It's interesting to see what investors and consumers are really choosing right now to spend their money on.
I gotta say, I'm a little hesitant about some of this stuff as somebody who covers the economy, and we look at people's vacation plans and when that comes in certain surveys. And yeah, it is obviously the easiest thing to cut out of a discretionary budget, but I don't know. Then we see what these companies report for earnings, and it seems like, oh well, we still went on that trip anyway. So.
True. But then you guys see Torsten Slok's note today that talked about Bank of America credit card use and how it's on the rise, particularly for lower income consumers versus middle and high end. So that also I feel like would be
buy now, pay later, of course, too. Had that great big take yesterday to read.
One of the top performing stocks, though, in the S&P, Nora, is Equinix. Am I saying that right? Because that's Equinox.
Not Equinox.
I say Equinix, but this is in my patch.
Okay, I say what you say.
I cover real estate stocks, and so this falls in my realm. But Equinix, that's ticker EQIX. The shares are rising. They're surging for their biggest gain in nearly 16 years. That's since 2008. And this is coming after the closure of an internal investigation into its accounting practices actually overshadowed the cut to its full year revenue.
Yeah, clearly.
It reported earnings, and it came in later than a lot of analysts and investors were expecting. So that kind of was what was in focus prior to this. But TD Cowen says that apparently its earnings came just in the nick of time because they were able to include this fact that the probe has officially ended. But investors aren't still really paying as much attention to the fact that it's still being subpoenaed for an additional probe by the SEC. But it does seem like this is some good news in terms of the front of the internal investigation being over. But that's what I'm kind of eyeing when we look forward here.
All right, before we let you go, Norfolk Southern.
Yes, watching Norfolk Southern. Those shares are sliding as much as 5.2%. And this is after investors rejected a plan to oust its management. Of course, this has really been in focus over the past couple months, but the Activists actually did win 3 seats on its board, but they failed to replace the railroad's top executive and all of its directors.
All right, Norm, thanks a lot. We really appreciate Norma Linda joining us there. Covers everything for Bloomberg News. We very much appreciate that. I also mentioned Roblox. That stock is down a whopping 23%. The bookings outlook raised some questions. That really fell short. We also have a really interesting move here with HubSpot and Alphabet. Do I know those things? I don't really know those things.
No, but Mandeep Singh thankfully does.
And so does Niraj Patel. So Mandeep Singh is senior technology analyst for Bloomberg Intelligence. Niraj Patel is Bloomberg Intelligence senior software analyst. Luckily, they can have us covered on all of this. Niraj, what is HubSpot and what does Google/Alphabet want with it?
Yeah, hi, Alex. And HubSpot, they are playing directly into sales and marketing software. Small player, well below the scale of Salesforce and Adobe. They have about $2.5 billion in revenue relative to a $40 billion Salesforce scale. So much smaller. They target SMBs. Their average customer is about 50 to 100 employees. So they offer this type of platform, which is about 210,000 total customers, to Google to maybe enhance some advertisement and leverage CRM as a gateway for AI into software for Google.
This is a pretty big, potentially, acquisition. So I want to bring in Mandeep Singh here, who's with us in the studio today. Hey, Mandeep. So this would be a company right now that's valued, HubSpot, that is, around $30 billion. So much talk of antitrust going on in the tech space. Is this something like Google could really pull off?
I mean, they could, in theory, simply because Microsoft recently bought Activision, and that was close to $70 billion. So, you know, any acquisition here would not be north of 35, 40 billion. So from that perspective, you know, given Google is not a player in application software, I think the antitrust argument is pretty weak in terms of, you know, preventing them from acquiring HubSpot. And in terms of why they are looking to buy an asset like this, look, Google's primary business remains ads. They are big on the, you know, the foundational model side with generative AI. They have the cloud infrastructure. So getting a CRM play for training your models is something that is quite forward-looking. I don't think the market fully grasps what they're trying to do here. But it does make sense because in the end, if you have to deploy generative AI at the enterprise level, you need data. And who better than a CRM company that has got data related to, you know, an enterprise system, sales system. So it does make sense that they are trying to apply that kind of AI in the context of an enterprise.
Right. Well, to your point of, you know, maybe investors not quite grasping it yet, Google shares more or less unchanged on the day, actually slightly down, but you think this could be maybe a more positive, longer-term story for the stock?
I mean, these companies don't make acquisitions for inorganic growth. It isn't about the revenue contribution from HubSpot. It is more about how can they position themselves better at the enterprise level. And in the case of Alphabet, look, they've never had an enterprise business before Google Cloud. So the fact that they have a $35 billion Google Cloud infrastructure business, they can add this CRM asset, and then the generative AI aspect is huge because that's where everyone is expecting all the growth to be.
Niraj, do you like the numbers that we're looking at here? I mean, what do you think it would be worth if Alphabet had to take it over? Wanted to take it over?
Yeah, this is HubSpot's landing at the high end of app software valuation today. It's about 12 times on a forward sale. Some of the comparable peers in SMB space are half of that multiple. So, you know, given Google's balance sheet, they have the appetite to keep pushing the valuation to a higher level. The offset here, not from the numbers, but from a perspective of HubSpot management, this is really their baby. They're going to have a very hard time letting go. You have 2 active co-founders, and one is still very active in all product development. He's the current CTO. So there will be a little resistance from the management perspective.
So, Niraj, real quick on that, could somebody else come in and make another bid that would make them feel better?
They probably prefer a Google that's not in CRM software versus a Salesforce, Adobe, SAP type of company where they would just be rolled up into an enterprise portfolio.
So if we were to think, Mandeep, of how something like this could hypothetically be financed, obviously cash not a problem for Google. You think this is something they would buy in, just with cash on the balance sheet, or would go to a debt or equity market?
I mean, look, they've been more shareholder friendly recently with the announcement of a dividend. So clearly they are making changes to their capital structure. I wouldn't be surprised if they go to the bond market to finance such a big acquisition.
Even with these rates?
Yeah, but I mean, Google is like AAA, so
yeah,
everyone would be like happy.
Probably can borrow
sure.
basically cheaper than the government can.
Yeah, so I don't think financing is an issue, but the regulatory scrutiny is going to come no matter, whether they compete in that same space or not, given the size of a potential deal. But I think they can convince the regulators that this deal makes sense for them.
Can we go to Roblox for a second? Because Mandeep, you also covered this. So my knowledge of Roblox is this. My daughter comes in the morning on Saturday and Sunday, takes my phone, and plays Roblox on my phone, Warrior Cats. That's all I know. I don't really know what that means. She's not allowed to talk to anyone online, and she basically makes cats fight each other and get animals and
you know more than me.
Stuff. That's all I know. What's going on? But she plays a lot.
And I bet you she's using your credit card to make those Roblox purchases. She is.
Alex's face just sunk.
What are you saying? I think Roblox wants her to do that, but why is the stock down like 23%?
Well, so in this case, I mean, engagement is what drives all these platforms, and the fact that we are going into summer months, it's kind of natural to see some seasonality in terms of engagement coming down. So hours spent were 3% below consensus expectations, even though the user growth was in line with consensus, 20% user growth. And to my mind, the long-term story is still intact. They have the content to drive, kids of that age, and they have the engagement. There will always be seasonality, and once in a while, the stock will react like this because expectations were higher. But there was nothing on the call that suggested they're losing their engagement to social media. Yeah, and so I think this is a case of market being in that mood where if it's not a beat and a big raise, your stock is going to get hit, and you're seeing that with Roblox.
Tough crowd. Yeah. This is something that I wanted to come back to. I cover the economy in my regular job here at Bloomberg, and we actually were talking to the lead economist of Visa not too long ago, and they had some great research out about how the gaming economy has really added so much in terms of consumption just by virtue of so many people being on computers, being exposed to so many more ads and buying more things, not just within the game, but in the broader internet at large. And I don't know, it's not. Do you see the connection with that as well in this gaming world, and how that's also just boosting aggregate consumption?
I mean, Roblox did call out virtual shopping being a potential driver for 2025. So even though no one talks about metaverse now, the fact that, companies are still talking about virtual storefronts, and the fact that you can do shopping on these kind of platforms down the line goes to show that gaming is something that everyone feels contributes to this AI wave, as well as, largely e-commerce connection in terms of, the storefronts and how the behavior could change down the line.
What do they sell in there? What can you buy on that shop?
I mean, that was the whole promise of metaverse, that you can replicate malls in the metaverse. And so if I'm a Walmart that is setting up a grocery or, their shop in that kind of a virtual storefront, I can drive that kind of experience where people feel they are inside the mall when they're sitting in front of a computer, and they can do a lot of the shopping, which, again, was the promise of metaverse. They were probably 3-4 years too early, and it will take time to build that.
All right, Niraj, I know you're still here. Sorry, we need to get more info on Roblox, basically so I understand what it actually is when my daughter's playing it. What else are you working on right now in your sphere?
I think there's a big dichotomy with the valuations that are occurring in software. You're seeing the SMB companies like a HubSpot, which is a little bit moving against the wave. The rest of the companies are getting hit because small, medium business spending is quite constrained. And you're seeing a significant downward push on valuation multiples for other companies like a Klaviyo, like a Paycom, Paylocity, a whole host of companies in app software.
All right, guys, we really appreciate it. Thank you so much. can't get any more, can't get better than this. You're at Niraj Patel, Bloomberg Intelligence Senior Software Analyst, joining us, and Mandeep Singh. He is Bloomberg Intelligence Senior Technology Analyst. So do we think that she's buying stuff on my card on Roblox?
I mean, the way that your face just sunk when he said that, I feel like you want to take out your credit card right now and be like, was I charged for this?
I kind of do.
Do you know if it's on there? If the information's loaded?
It's not on. I wouldn't.
There's got to be a free version.
I don't know. John Tucker's looking at me like, you're dumb, Alex. What are you doing? All right, we're going to stay in the technology space. Coming up next, Mark Gurman, Chief Correspondent for Global Technology, will be joining us. He's a great story for the Bloomberg Big Take on Apple insiders that could succeed Tim Cook. We're going to break all that down. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages, I'll call it mixed to little change at this point. Earnings in the driver's seat and the economic data close by in the passenger seat. Most active stock right now, just talking about it, Roblox, those shares down 22%. Real estate, the best performing industry group in the S&P 500. That's where you're going to find shares of the REIT Equinix, however you pronounce it.
Equinix.
Equinix?
That's what Norma Linda said. I trust her
Let's
to
go
say
with
the
that.
right things.
A probe of its accounting has ended, and those shares right now, they are down close to, well, let's get a reading on this. They're down up about 12.7%. So the earnings report taking a back seat to the fact that this accounting probe, internal accounting probe, is over. In the economic data, you had earlier today signs of some financial stress. Roughly 1 in 37 U.S. homes considered seriously underwater, carrying mortgage balances at least 25% more than their market value. And also earlier today at 8:30 this morning, we had the weekly jobless claims. They came in higher than what economists surveyed by Bloomberg had expected. As a result of that, we have the 2-year yield down 2 basis points right now. That is at 481. S&P 500 6 points higher. That's up 1/10%. We're at 5193 on the index. The Dow Jones Industrial Average up 137 points. That's a rise of 0.4%. And right now the NASDAQ 128 points lower. That's down 0.2%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash.
What's so funny?
What are you laughing at?
It's been a very long day.
It has been a very long week, actually. I'm Alex Steele, alongside Molly Smith. Paul Sweeney is off today. You're listening to Bloomberg Intelligence Radio. We cover all the top news in economics and finance with our top analysts all around the world. They cover 2,000 companies and 130 industries. Molly, get back to this jobless claim thingamajig, because isn't that just basically New York City's fault for having school break?
Yes, and when we were covering it this morning, I was like, oh wait, no, they didn't have break last week. Wasn't it closer to Passover? But I was thinking of my hometown in New Jersey, so that was my fault for confusing it. But, maybe when I have kids of my own, I'll be more in tune to the New York City public school spring break schedule. Also, but that's what happened.
I felt like it was longer. Maybe I'm wrong, but usually it's a week.
They were for a week.
It was a week and a half.
A week and a half, was it?
Which was a bit, which I didn't realize until she didn't go to school that Monday. But that was a little bit tricky.
It's interesting because, this is like something you got to pay attention to around this time of year, that New York City public school workers, like bus drivers, they're allowed to apply for benefits during these breaks. So,
that's
this is something that is probably going to revert in the next week. So don't be too worried.
This is an excellent point. Let's move on to another tech story. It is on the Bloomberg Big Take today, and the title is "The Apple Insiders in the Running to Succeed Tim Cook." Only one person you can talk to about anything to do with technology and Apple, and that's Mark Gurman, Bloomberg chief correspondent on Bloomberg Technology, joining us. It was so interesting when I read this because I don't think I have heard of anyone talking about succession with Tim Cook, but he's been around for a very long time.
Thanks for having me. That's right. Cook has been around for over 2 decades at Apple now. He was named CEO in 2011, obviously taking over for Steve Jobs. He's turning 65 next year. He's one of the older CEOs in the S&P 500. They have a management team that's essentially been the same cast of characters for a decade plus. And they're in a precarious position right now, battling smartphone slowdowns, battling a shift of manufacturing out of China while trying to keep China still happy, regulatory concerns in both the U.S. and the European Union. So there's a lot going on, but Tim Cook's getting up there, and it's time to start thinking about who comes after Cook. And so my story this week takes a look at some of the options, and I'll just give you the quick summary here. If he were to step down in the near term, he'd likely be replaced by Jeff Williams. He's the chief operating officer. If he stays around about 5 years, as many expect, including me, he'd likely be replaced by John Turnus. He's the company's senior VP of hardware engineering, and he's been playing an increasingly important role in product development and other aspects of the company.
So, Mark, this was a great point that you made in this story. So Tim Cook, he's 63, older than a lot of his peers in the average Fortune 500 C-suite company. But it's interesting because there was a quote from somebody, saying, if Biden, Trump could be president at 80 years old, like who's to say that Tim Cook can't stay on as CEO, or that, someone else of one of his peers who's maybe also in that same kind of age range also couldn't be suitable for it.
Yeah, he certainly, could stick around, right? I mean, if you can run the country at that age, you can run Apple at that age. But I don't think that's what Apple's board of directors or Tim Cook would want, to be honest.
Why not?
Well, I think there's a culture of passing the baton, right, in these corporations. And Tim Cook is going to want to give someone else a chance, right? It's a technology company. And, many people want someone who, grew up in Silicon Valley, someone who is newer and more innovative to take over these tech companies. So I just don't think Tim Cook at 80 years old would want to run Apple or should run Apple.
It doesn't sound like Tim Cook has talked a whole lot about this. You mentioned I thought this was kind of weird that of all places where Tim Cook has shared the most about, his life after Apple has been on a podcast with Dua Lipa. Didn't see that coming. I don't know. Is she like
definitely did not see that coming.
Like, is this like the place to go if you're going to drop some secession news?
Well, Tim Cook doesn't do many interviews, right? He does a few a year. And, to be fair, Dua Lipa probably asked the best questions of any interview that I've seen Tim Cook participate in a while. And she brought up the succession question. Obviously, that was a little surprising that she brought that up because it doesn't seem central to, her line of questions that the rest of the podcast had. But she asked, and Tim Cook gave his most in-depth comments on the subject to date.
You mentioned a hardware engineering person that may be taking over if it's longer than 5 years. Why not like an AI-ish person?
Well, it's not necessarily because John Turnus is a hardware engineering person that he's going to be taking over the company. It's mostly because he's in the right age range. He's so important to the company. He has excellent managerial skills. He's extremely well respected inside the company and within the industry. So he has a lot of things going for him other than obviously very important being the hardware engineering person. In terms of not an AI person, well, Apple's AI person, John Giannandrea, quite frankly, I don't expect him to remain at Apple for many more years. And I certainly don't think that he's primed to run the whole company. He joined Apple in 2019. For all intents and purposes, he's an outsider. When you're at Apple, you really want to gain steam there, especially if you're going to be the next CEO. You really got to be there for 2 decades. It's a cult, right? You're not going to see someone be able to be CEO who comes in from the outside. And their head of AI, for all intents and purposes, like I said, is an outsider.
So when Steve Jobs was, toward the end of his tenure, obviously he was battling cancer at the time. What kind of circumstances, barring, a health crisis, which of course we hope that wouldn't happen, but what kind of circumstances do you think would be fitting for Cook to step down under?
Well, Cook is going to run Apple as long as he wants to run Apple, right? Like I said, I don't think that's going to be until 80, but I wouldn't be surprised if he remains at Apple until 70, right? And the circumstances would be when he feels it's time to pass the baton. No one is going to force him out. There's no retirement age. There's no requirement. So it's going to be as long as he wants to run the company. And so there's no circumstance that I think would push him out the door.
It also feels like managing Apple is also about managing geopolitical relationships with China. Like, how do you think that kind of overlays, or am I making too much of a big deal about it and it's actually a cyclical thing and I should chill out?
Well, no, I think that's extremely central to the CEO role, right? And the thing that's going to test Turnus the most is how do you operate on the world stage? Now, there's something else to really understand here. The CEO of Google, Sundar Pichai, the CEO of Microsoft, Satya Nadella, they are both engineers who took on the CEO role, just like I expect Turnus to eventually, right? But both of those people have an executive there that manage the relations for them, right? Microsoft famously has a president whose name is Brad Smith. He handles all the international relations, right? Sundar Pichai, they made their CFO, Ruth Porat, right? She now manages these international relations and these issues. So the CEO doesn't necessarily have to be the person who manages these relationships. The reason Tim Cook does it at Apple is not because he's the CEO, that's because he's the best at it, right? And different CEOs are going to have different skill sets. And being the CEO doesn't mean you have to do everything. It means you have to do a mix of things, but have the ability to appoint the right person and put the right people in position to do the things that you're not good at.
Last one for you here, Mark, 30 seconds. Tim Cook's talking about maybe life after Apple being something more philanthropic. Any ideas on what that might be like?
Well, obviously, he generated a lot of money while being CEO of Apple. My belief is he's going to open up some sort of charitable foundation and make donations to, various places. I would say the best comp to this would be something like what Mackenzie Scott has been doing, or Lorraine Powell Jobs. Both have opened foundations over the past, several years, and make philanthropic donations on a pretty targeted basis to specific entities constantly. And so I would expect Cook to do the same.
Really appreciate it, Mark. I know it's early where you are. We appreciate you getting up for us. Mark Gurman, Bloomberg Chief Correspondent on Global Technology. And you can read this great story on Bloomberg and also at bloomberg.com/big take. Don't miss it. It's always a good read, the great insight that only Mark Gurman can give you. Coming up, you got Barry Ritholtz. He's always outspoken. He always has thoughts. He's founder of Ritholtz Wealth Management and host of Masters in Business. He had a recent note on TikTok. We're going to break it down with him right after this. For now, let's go to Michael Barr with world and national news. Michael.
Thank you very much, Alex, Molly, John. Stormy Daniels is back on the witness stand this morning in Donald Trump's criminal hush money trial. The former president accused of falsifying business records tied to buying off the adult film actress over an alleged sexual encounter. Trump spoke briefly to reporters on his way into the New York City courtroom.
There's no case. Should have never been brought. Alvin Bragg didn't want to bring it. Cy Vance didn't want to bring it, and he didn't. He left. He didn't bring it.
Trump called the case purely and simply election interference. President Joe Biden says he will not supply offensive weapons that Israel can use to launch an all-out assault on Rafah, the last major Hamas stronghold in Gaza. Biden highlighted the potential loss of civilian life if Israel invades the densely packed city.
If they go into Rafah, I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks like came out of the Middle East recently. But it's just wrong.
Biden, in an interview with CNN, says the U.S. is still committed to Israel's defense. Severe storms are tearing through the southeast U.S., spawning damaging tornadoes, producing massive hail and killing 2 people in Tennessee and another in North Carolina. The storms have cut across the country this week, from the plains to the Midwest and now in the southeast. Gaston County, North Carolina is still assessing the damage brought by a major storm that swept through yesterday. County Board of Commissioners Chairman Chad Brown.
Storm came into Gaston County, uprooted trees and did a lot to our thoroughfares of trying to get some of our roadways cleared, but also a lot of power lines are down.
Officials say at least 4 people have died in storms since Monday. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages have all just turned higher. You still have technology weighing on the broader stock market. That's because shares of NVIDIA right now, they are down 1.6%. We did have data out this morning showing a jump in jobless claims to the highest level since August. Fed traders slightly amping up their policy easing bets for this year as a result of that. As we look at treasuries right now, the more policy reactive 2-year, 2 basis points lower. The yield right now 4.81%. Right now, the S&P 500 15 points higher. That's up 0.3% at 5203, above 5,200. Dow Jones Industrial Average 201 points higher right now. That's up 0.5%. And the Nasdaq 100 23 points higher. That is up 0.1%. Eric Friedman at U.S. Bank explains how he's been approaching markets. Well, let's do Airbnb. Those shares sinking after the home rental company delivered lackluster guidance for a second straight quarter. As far as your earnings scorecard, 455 companies in the S&P 500 have reported so far this season. Of those, 79% have delivered positive earnings surprises. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Molly and Alex.
Thank you so much, John Tucker. I'm Alex Steele. Here with Molly Smith. Paul Sweeney is out today. This is Bloomberg Intelligence Radio. We cover all the top news for you through our lens of Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. Here's what's so interesting to me, and I mean, this is nothing new, but sort of the two-speed economy that I feel like we keep seeing, in that certain areas of the economy, the lower income, spend more on credit cards, buy now, pay later, NFIB, the small business sentiment, all weaker, but companies, big companies, good earnings beats, profit continues to grow, buybacks happening. Basically, the rich get richer and the poor get poorer.
It's sad, isn't it? Yeah, we see that too in like some of the jobs numbers that are broken out by firm size, and you see that like way more of the hiring is also being done at firms that have at least 500 employees. So
interesting.
Great to be in a building like this, you know, but for much of America, what is it, like half of America works for a small business, right? Isn't it something like that?
And then so even if you have wages keeping pace with inflation, big if, that's still sort of the cloud. That goes a long way to explaining the clouds that we feel, even if we don't see it.
Yeah.
Clouds for TikTok? Yeah, go ahead.
That's just kind of sad. I hope we talk about something more positive.
I don't know. Today,
as somebody who covers the economy, you know,
I'm
it's
not
just
feeling it.
I'm looking for the happier news.
I don't feel it.
Maybe Barry has it. You think he does?
I don't think he has it.
Okay.
Barry, do you have happier news right now?
Well, the silver lining in...
He does.
He did it. Barry Ritholtz right here, founder of Ritholtz Wealth Management, host of Masters in Business. Take it away, Barry. What's the good news?
So the silver lining is whenever the economy sees a lot of these scams and frauds bubbling up especially from social media and the internet, it's usually because the economy is so strong and people have so much money that it attracts the fraudsters. I'm not saying the fraudsters disappeared in the middle of 08, 09, but you really didn't see a lot of them other than the ones who were revealed by the financial crisis, like Bernie Madoff couldn't perpetrate his fraud anymore because he couldn't make up numbers anymore. But, you know, it's a unfortunate side effect of a lot of wealth is, you know, why do people rob banks? Because that's where the money is.
Yeah, I was talking about someone yesterday about Bitcoin too, and just sort of going down the scale in sort of the Bitcoin products that are being offered and the crypto products that are being offered and the question marks around it as there's just so much money sloshing around. I don't know, you're going to relate this to TikTok, aren't you? Because that's part of where we're getting a lot of our news and information, right? What do you make of the whole ByteDance is now suing the U.S. government for forcing a sale of TikTok, but then you still have, say, Steve Mnuchin into TikTok in some way? What are you making of all this?
Well, let's give ByteDance credit for what they do better than either Twitter or Instagram or Facebook, which is they have created an algorithm that knows exactly how to tickle your dopamine receptors. And, you know, once you fall down a rabbit hole of a particular type on TikTok, my wife, it's all about rescue dogs on TikTok. And it's just endlessly charming videos about dogs that have been saved. But there's a darker side, whether it's investing or day trading or taxes or go down the list. You know, some of the crypto scams, you can earn 20% a year back when the risk-free rate on the 10-year was 1.5%. And here's what you do. You max out your credit cards, you go buy a house, you put this money, earn 20%, you use that to pay off the house, and hey, in 7 years you own this house and it costs you nothing. Like that sort of stuff is incredibly irresponsible, and it's all over TikTok.
How so? I mean, I'm someone who admittedly is not on TikTok, but tell me like what kind of posts that would come across in.
So for people who are not on TikTok, like I'm not a big TikTok user. I tend to be more of a Twitter user. But one of my favorite follows on Twitter is TikTok Investors. And this is a person who is in the financial industry, but not authorized to speak on behalf of their employer, so they have to be anonymous. And they've been curating some of the most outrageous money-losing videos from the experts, from the finfluencers at TikTok. And as I wrote in a note this morning, they range from merely wrong to risky to actually criminal, where people are giving tax advice that if you follow, the IRS is going to have a little conversation, and it's going to be expensive.
Well, but Barry, do you feel that as parts of the economy slow and as we go to a slowing or normalization, aka liquidity comes out of the market, do these things stop, or do you think like we're just in it now?
So here's the thing that I think people kind of overlook, because we all have a tendency to see the world from our own unique perspective, and only some of us are paid to step back and look at the 30,000-foot view. There is just so much money sloshing around the U.S. economy. It's not just stocks and bonds. It's not just the $6 trillion with a T, trillion dollars that flowed into 5+% money market accounts. But you look at venture capital, you look at private equity, you look at private credit. There is just trillions upon trillions of dollars in the U.S. economy. And even as things start to slow from the massive fiscal stimulus of the pandemic era, remember, CARES Act 1 was the biggest fiscal stimulus since World War II. It was 10% of GDP. We've never seen something like that in a few generations. Then CARES Act 2, both of those under President Trump. Then CARES Act 3 under President Biden, to say nothing of the other 10-year-long sort of infrastructure, semiconductor, all the other legislation that came out. There's a lot of money out there, and it's going through the economy. And when people have been erroneously forecasting a recession, we can have a whole long, complicated discussion as to why or why not a recession hasn't happened. But it comes back to too much money, too strong of an economy for a true, persistent, and pervasive contraction to take place at this time.
Yeah, I mean, that's really the story of the economy all these days, right? That demand that just will not rein in. Last one for you quickly, Barry. We're saying in this note here on TikTok that investors should consider making some changes on the very social media themselves. 30 seconds. What do you mean by that?
So you have to be very wary about claims that are just too good to be true. Turn $100 into $1 million. Hey, all you have to do is earn 2% a day. Seems kind of ridiculous. Don't pay taxes. Just be on a boat on tax day on April 15th. Utterly ridiculous. Some of the other stuff, here's why we're teaching our kids to day trade from home.
Yeah.
I mean, really? Is this good advice for anybody? So be skeptical. Anything that seems too good to be true probably is.
All right, Barry, we really appreciate it. Fun to chat. Barry Ritholtz joining us there. You can check out his Masters in Business podcast. Check that out, definitely. Someone was telling me that his 23-year-old son is like, let's talk to me about dollar yen. Like, how do I trade that? And my colleague was like, please don't do that.
Far and above where I was at 23.
Yeah. Same. All right, coming up, we're going to break down one other depressing topic, and it has to do with mortgages that are underwater. So stay with us here. This is Bloomberg.
company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with a look at some of the company stories we are following. Moderna's pioneering COVID shot turned the company into a nearly $200 billion biotech giant and a public health hero. The second vaccine, which is meant to prevent a common respiratory virus, is now calling into question the premise on which the company has staked its entire business. The forthcoming RSV shot, expected to get regulatory approval this month, is Moderna's first chance to show the versatility of messenger RNA technology to more effectively treat and prevent a range of illnesses from the flu to cancer. It's going to be the first mRNA product for something other than COVID, yet the vaccine doesn't clearly perform any better than what's already on the market. The Justice Department stepping up its focus on competition in AI. Top officials say as big tech companies invest billions of dollars to gain an edge in the new technology, they want a part. The Department of Justice convening a workshop at Stanford University, May 30th. They're bringing together industry leaders, researchers, and government officials. The workshop comes as the Biden administration antitrust agencies are pursuing cases against some of the biggest technology companies, including Alphabet, Amazon, and Meta Platforms. And I know you said about this one. Bye-bye sedans. In a significant shift, General Motors, yes, has announced plans to cease production of its gas-powered Chevy Malibu later this year. It also declared a temporary halt in production of the Cadillac XT4 after January 2025. The company's been shifting its focus from cars to the production of more crossover and sport utility vehicles. Bigger margins for those vehicles. And that's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday Eve. I know we're all feeling it. I'm Alex Steele. Paul Sweeney is off today. Molly Smith is sitting beside me here. This is Bloomberg Intelligence Radio. We are broadcasting live for Interactive Broker Studio right here in Midtown Manhattan. We are also live on YouTube, so go ahead and check it out. We bring you all the top news in economics and finance through a lens of our wonderful Bloomberg Intelligence analysts. We also bring you world and national news, and for that, we go to Michael Barr. Michael?
Thank you very much, Alex, Molly, and John. Porn actor Stormy Daniels has returned to the witness stand in Donald Trump's hush money trial in New York. Trump's defense is cross-examining Daniels and her testimony about an alleged sexual encounter and the money she got to keep quiet. The former president spoke to reporters briefly on his way into the New York City courtroom.
This is purely and simply election interference. There is no case. So that's the way it is, but here we sit after 2.5 weeks, and I think you'll see some very revealing things today.
Trump denies he had sex with Daniels. President Joe Biden says he won't supply offensive weapons Israel can use to launch an all-out assault on Rafah in Gaza over concern for the well-being of the more than 1 million civilians sheltering there. Biden acknowledges civilians have been killed in Gaza by the type of heavy bombs the U.S. has been supplying. The president told CNN the U.S. is still committed to Israel's defense and will supply Iron Dome rocket interceptors and other defense arms. Hardline Republican Representative Marjorie Taylor Greene tried to oust House Speaker Mike Johnson. It didn't go well.
Declaring the office of Speaker of the House of Representatives to be vacant. This is the uniparty for the American people watching.
Gentlelady will suspend. Order.
After Greene called for a vote to vacate, Republican Majority Leader Steve Scalise quickly countered by calling for a vote to table Greene's motion. An overwhelming majority, 359 to 43, kept Johnson in his job. Johnson after the vote.
They made their voices heard on the motion to vacate matter, and now we have very important work to do for the country. There are a lot of things to fix.
Speaker Johnson says hopefully this is the end of the personality politics. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Alex, Molly, and John.
Thank you so much, Michael Barr. Personality politics, like that's ever going anywhere. Okay, the best read story on the terminal is right up Molly's alley. She covers the economy for us, so this is perfect for her. The title is "Seriously Underwater Home Mortgages Tick Up Across the U.S." that usually happens either one, you don't put enough down payment on, so if the value of the house falls, you get hurt, or you stop paying your mortgage, right? I thought we were past all this stuff.
Or if you overpaid for the house to begin with. Yeah, so this is, so right now, this is the way that an underwater mortgage is defined is if you have a mortgage balance that's at least 25% more than the market value of the home. So that's, right now, this is 2.7% of homes in the U.S. fall into this category of being, quote, seriously underwater. So this is like, obviously, you know, it doesn't sound positive, and it's not. You know, this is like really limiting homeowners' ability to refinance or take out equity of their home if your mortgage balance is that much higher than the price. So it really limits your options, and a lot of people right now obviously are looking to refinance, or maybe you do want to take out a home equity line of credit. Tough to do that when the mortgage value is so much higher than the home price.
It was interesting with the states, too. We're looking at Kentucky, Mississippi, Oklahoma, Florida, and Louisiana, just for the top 5 of those states that have seen the most increase in underwater homes. Do we learn anything macro-wise from that? What's up with that?
Yeah, to see that there's so many in the South, I mean, if you are thinking about like where so much of the home price appreciation has been in the country in the last few years, obviously the South has benefited from a lot of the migration patterns, but maybe those people did overpay at the height of the housing market, like, you know, a year or two ago.
So maybe we've seen the peak in that. Anyway, it's a really great article, guys. I recommend that you check it out. Coming up in the next hour, Andrew Bailey, the Bank of England governor, speaking with Bloomberg Television, Francine Lockwell. We're going to bring that to you. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday Eve. I'm Alex Steele. Paul Sweeney is off today. Molly Smith sitting in. She covers all things economy related. We're going to get to lots of fun stories related to that in just a moment. Coming up, we got you covered on the stock angle and the economy angle. Geetha Ranganathan will be joining us on Warner Brothers Discovery earnings. Also rumors of some cost cutting that could happen again for the company, maybe even at CNN. We'll break that down. Also, we're going to be hearing from Andrew Bailey. He's the Bank of England governor. Two governors now see the case for a rate cut. It looks like the direction of travel is eventually moving that way. Now the question becomes, who goes first, the BOE, the ECB, or the Fed? We'll break all of that down for you as well. We also want to keep you updated on all the top business headlines and stories, and for that, we go to John Tucker. John.
All right, and this Bloomberg Business Flash being brought to you by BNY Mellon Insight, June 4th to the 6th in Nashville, Tennessee. No, they're not sending me. Don't miss the essential event for the financial advice community. Visit insight.bnymellon.com. Stocks edging higher right now. Fed traders slightly amping up their policy easing bets for 2024. Right now, you have 10 of the 11 major industry groups in the S&P 500 higher. Real estate and energy leading the way, and technology, that right now is proving to be the biggest drag. You have shares of NVIDIA right now 1.4% lower. Russ Kostridge at BlackRock says some stocks are priced to perfection.
The market is not cheap, and this is a year where stocks are going to be driven much more by earnings, by cash flow, by profitability. If companies are not showing investors what they like, they're getting punished very quickly.
Right now, the S&P 500, 19 points higher. It's up 0.4%. We've crossed over 5,200 again, 5,206 right now for the index. The Dow Jones Industrial Average up 196 points, a rise of 0.5%. The Nasdaq 100, 39 points higher. That's up 0.2%. Two-year yield, 1 basis point lower. That's at 481. The 10-year, that's unchanged. That's at 448. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Molly and Alex.
Thank you so much, John Tucker. So if you were listening the last hour, you knew that Molly Smith had a dream last night about anchoring radio with me where I was wearing a maroon shirt. I am wearing a maroon shirt, so maybe she's like some sort of psychic. Apparently, do you know this?
Dreams do come true, Alex. What can I tell you?
She mocked me.
Dream about me and wearing a vest?
I can't say that I did, but you
that
know,
would have been a dream. That would have been a nightmare.
I would point to this, by the way. Apparently, color psychology says that maroon is associated with control, responsibility, and thoughtfulness.
I would use those things to describe you.
I mean, that works. I don't know what vest is. What does vest represent?
Make sure to search that the vest says Bloomberg Data Solutions on it.
I don't know.
That might narrow the results.
I don't remember who I stole this from here at the company.
There's no way that you came across this organically. I don't know how you acquired this.
They love me so much in Data Solutions, they sent me a vest.
Those people don't even sit in this building.
Whatever, guys. I'm thoughtful and stuff, so that's what my shirt color says. Okay, Molly, thanks for joining me. Really appreciate it. It is a little bit of a subdued day, isn't it?
Yeah, totally. I mean, we've been wondering are we going to talk about how my couch is getting delivered today?
It's true. We got a lot.
I joined a pickleball league.
I think the pickleball is going to be huge when Jason Kelly joins us later in the hour.
Yeah, we are definitely going to have to talk about that with him.
Yeah.
All things business of sports, a lot of money going into pickleball these days.
Yeah, and we'll do the deal, and then we'll do pickleball. I feel like this is a great time.
All right, we set that up so well just now.
Yeah, we did, didn't we? All right, let's set some more stuff up. Let's go to Norma Linda now. She joins us from Bloomberg News. You're looking at Warner Brothers Discovery. We're going to talk to Geetha in just a second about this, but give us the broad strokes here. That stock is up by about 1%.
Exactly. So it is rebounding after it had its sales fall short of estimates, and as it wrestled with lower TV ad sales and poor video game performance. Now it generated sales of $9.96 billion in the first quarter. That's down 7% from a year earlier, but the street was looking for $10.3 billion. But what I'm really focused on, right, is the news that Disney Plus, Hulu, and Max are planning to combine into a streaming bundle. I'm curious, they haven't put the pricing out on this yet. We don't know, but we do know that it'll be accessible in all these different platforms, and it'll be offered as ad-supported and an ad-free plan. But I'm curious, do you think that people are actually going to go out and buy this? It feels like it's almost turning back into what we had with television.
Do we need another streaming service?
But it's already there. So, I'm paying for all these three things individually.
Separate, right.
But my question is, are they going to, come to me and say, hi, we can bundle this together. Here's the price.
Right.
Or I'll just buy the bundle, forget that I also have the individual, and then, I'm double paying for months.
See, that's what
tragic.
they're going for. That you're going to double pay.
That we forget.
Yes. They basically want Alex
that must be it.
I'm going to need to see a good discount to push me over.
You don't have all three of them.
I don't. I mean, I have, of course, am I admitting to sharing passwords? Yes. But I have Disney Plus through a family member and a few others, but I'm interested to see how this bundle works out.
Okay. You know that I had a 10-year-old the other day sell me on password sharing?
Really? Wow, you are vulnerable.
She was like, yeah,
she's compelling.
You can watch this show and, you ask someone who has it and you can share passwords and stuff.
God.
Yeah.
That girl needs to be running a company one day.
All right, Robinhood, that stock pretty much flat. So the results did beat. You would say saw nice momentum. What happened here?
I mean, yeah, we are seeing a big pullback because earlier it was up as much as 9%. Now, this is the second straight quarterly profit that the company has posted. But higher interest rates and cryptocurrency trading are actually what has fueled its revenue growth. Pretty interesting when we think about interest rates being a positive here. But crypto revenue more than tripled. And it reported earlier this week, of course, the potential lawsuit from the SEC regarding its crypto business. And that still remains on its heels. So I'm interested to see how all of this kind of factors in as we look at the future. But nonetheless, it did post a solid quarter here.
All right, last one, Roblox, otherwise known as where Alex's daughter has little cats fight against each other.
I was going to say, I brought this one back just for you, Alex.
Okay, so she's really into warrior cats. Apparently, they were a thing 20 years ago.
Okay.
And they're still a thing. And you can go on Roblox and make your own cats and play warrior cats. Where they
Gaming
eat
company.
each other and they eat things. And
okay, I'm going to have to check it out.
What's going on with them today?
Well, they are down. They're sinking as much as 24%. Now, this is the biggest drop that they've seen in 2 years. The forecast for bookings missed the average analyst estimate here. And this is the latest sign in the widespread headwinds that we've really been seeing for the video game industry as a whole. It expects $870 million to $900 million from bookings for the second quarter, but the street was looking for $902 million. The company is still trying to appeal to consumers. Of course, last month it did partner with Walmart. It was having players buy physical goods from the company, and it's also investing more in its advertising efforts, but we're really interested to see how this looks moving forward and whether or not it's able to really pull through here.
you imagine that? Say that like you're going to generate as much as $900 million in bookings, and the street's looking for 902, and your shares down 25%.
Yeah,
tough day. Market.
The IR department guy would be like, man,
Stinks.
so close.
Like
Come
somebody
on.
with
But
the
not good enough.
accounting could have certainly made this happen.
Yeah, exactly.
I'm just saying.
All right, Nora, thanks a lot. We really appreciate it. Norma Linda joining us from Bloomberg News. Let's get back to Warner Brothers Discovery. That stock is up by about 0.4%. As Nora was talking about, the company reporting sales and profit that fell short of analyst expectations. Shocker, lower TV ad sales, plus poor performance of video games. So no one better to talk to than Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media. Why is the stock up on the earnings?
Yeah, it was a little bit of a mixed bag, Alex. So definitely EBITDA under pressure as always, TV advertising, as you just pointed out. But they did have some bright spots, and I think that's why we're seeing a little bit of enthusiasm here. So one thing that they did mention was that, Warner Brothers and Discovery, it's obviously a merger. They've extracted so far about $4 billion in cost savings. They are now projecting an extra $1 billion in synergies. So that, I think, is something that, the street is definitely hopeful about. And then you have the streaming business. Remember, this is the HBO business that has now been rebranded as Max. And we're seeing some green shoots here. So, subscriber growth had kind of hit a wall. But again, we're seeing some reinvigoration here. So they had about 2 million subscriber adds, and they have a lot more momentum going forward because we're going to see a lot of overseas market launches. But that's not the real story. The real story is that the segment is actually profitable. And that is what has become the new gauge across the whole streaming landscape, whether the streaming business can be profitable. And obviously, Warner Brothers showing us how it's done.
I honestly, I will admit I'm not part of the gaming world, but I was under the impression that this is a pretty strong segment of consumer spending, has a lot of people who are very active in the gaming world. And it seems like for Warner Brothers, at least, this came down to one game in particular. How would you categorize that segment of the business, Geetha?
Yeah, so Warner Brothers, not necessarily known for, their video games in general, but they did have a huge blowout hit last year with Hogwarts Legacy. That became one of the biggest selling games throughout 2023.
And Harry Potter won.
Harry Potter won, just huge. And so when they were comping this year, obviously they knew coming into this quarter that it was going to be, tough comps. But then they also had their release from this quarter, which was, Suicide Squad, which really did not live up to expectations at all. And then you have obviously that Harry Potter effect, and that just didn't bode well for them for that studio/gaming segment.
The idea, though, right, is that the streaming part is going to wind up doing better, and that will eventually offset slowing TV ad sales, right? Where are they on that sort of balance beam?
Yeah, that's such a great point, Alex. That's the hope, right? That's what everybody's hoping for, that this transition would eventually pay off. And at some point, like, the streaming service would be better, or at least equal to, if not better than linear TV. But I don't know. I don't think it's actually going to happen, or it's going to take a very, very long time. Obviously, we've seen kind of Netflix set the stage here for everybody else. This year, we're going to see them throw out something like $10 billion in profit. So we know it can be done. I'm just not sure if who can do it, first of all, and if many people can, or many streamers can kind of replicate that success. Because if you kind of look at even the Max business, yes, it's good that they were able to show, throw out kind of $90 million in profits, but you're taking a business that was originally generating something like $2 billion in EBITDA every year. And so, you kind of then take it from 2 billion to, even if it's going to be 200 or 300 million, that's just a fraction of what it was generating. And that's kind of the whole story in media right now, right? You're trading the TV dollars for kind of these digital pennies. And so it does become a game of scale. And that's where kind of this whole bundling concept comes in, because that helps you kind of not only get more subscribers, but it helps you reduce churn, which is really the biggest problem for streaming right now.
Another big story in media is obviously just cutting costs, right? And Warner Brothers has done quite a bit of layoffs in the past year, and we had some additional Bloomberg reporting out this morning saying that CEO David Zaslav is looking to find more opportunities to cut costs, and that more layoffs could be part of that. Is that something, Geetha, that you're worried about?
I mean, yeah, this is kind of, again, been a major thing that Warner Brothers has been very good at, cutting costs. I mean, they did this originally with their first deal, which was the Discovery Scripts deal, where they went in and they eliminated a lot of those extraneous costs. They're really very, very good in terms of implementing, cost savings and synergies. And again, they've kind of, reproduced that same playbook with the Warner Brothers Discovery mergers. The thing with cost cutting is it's very tricky, because yes, you can cut out a lot of extra duplicative costs, especially in kind of streaming businesses when you're combining two streaming platforms, but you don't want to cut too much. You don't want to underinvest in content. And I think what they're going to do here is it's not so much about the content side of things, it's more about marketing and selling expenses. And that's again where, you kind of, yes, they're going to cut that, but that's again where you see how the bundling aspect could really help them, because that helps them save a lot of those marketing and advertising expenses.
Before we let you go, with the whole Disney Plus, Hulu, and Max together, I have a couple questions. 1, how much is it going to cost? 2, how much should it cost? 3, will they tell me that that's an option, or am I going to weirdly double pay for a while? And 4, I forgot the 4th.
All great questions. All great questions.
Excellent trifecta with an optional +1.
There was a +1 somewhere. It'll come to me in my brilliance.
So Alex, what we're paying right now, if you want just Hulu and Disney Plus without ads, is around $20 on the nose. And if you're taking the Max product without ads, that's $16. So combined together, that would be $36. Now, again, they haven't said anything on pricing yet. So this is just me speculating, but I would think they would, when they're kind of combining those three together, it would probably be at maybe a $30 or a sub $30 price point to kind of make it really attractive. In terms of will they, will you double pay? I don't think so. I think if you're a Disney Plus, existing Disney Plus or a Hulu subscriber, you'll just have kind of an option when you log in saying, this Max is available to you, and do you kind of want to switch your subscription? And that's how I think they're going to do it. And conversely, if you're a Max subscriber, I forgot your third question.
Me too. It was something about how much it would cost. Will they tell me about it?
And are you going to end up double paying?
Double pay. I think you hit them all. I did remember my 4th one. The 4th one, oh gosh, it went away again.
Oh no. Oh wait, I got a backup one.
Cable.
You go ahead.
Is this just about cable? Is this basically what I did with Verizon, but now I'm going to do it on my streaming TV?
It's very much the same idea. I mean, we're going back to bundling again. And I think what all of these services are trying to do, Alex and Molly, is they're just trying to now create the super bundle. Remember, Disney and Warner have another sports JV, a sports bundle that's going to come out in conjunction with Fox a little bit later. Right. So now they have this Disney Max bundle. I think eventually they're going to be, ask you to maybe have that extra super bundle along with, the sports, the sports option as well. So it's really kind of them trying to keep you on their platforms as much as possible.
Yeah, and isn't that just the name of the game? We do that here at Bloomberg too, always trying to keep people on the terminal.
Oh yeah.
All day long. So we're guilty of it too.
We understand where that goes. Geetha, thanks a lot. Thanks for playing with us. Geetha Ranganathan, Bloomberg Intelligence senior media analyst, joins us. Okay, so you're getting a couch delivered. I get that. Are you going to sit on the couch and watch all the streaming things?
I guess I have to decide which ones I'm going to be, signing up for. I mean, I do have the TV already in some of these subscriptions, but I was under the impression, I know I've got Hulu, Netflix. Those are each under $10 a month if you have the version with ads. These ones up here, we're talking $16 to $20.
Well, you saw my face, right?
So that's why I bring it up.
As Geetha's rolling off the numbers of how much people pay, my mouth keeps dropping, and I'm like, I paid that much for these things? That's the thing, is you say yes, and then you don't actually know where you're paying, and if you go through, you're wait, I'm paying $100 for all this? Why did I cut cable to begin with?
All you need is YouTube. The free YouTube.
I don't do that.
Everything.
No. Hello. We know I watch Survivor, so I need that. And then I have a child, and she needs options for when mommy needs to sleep.
She also needs warrior cats, which she could be
racking up my credit card bill.
The card on that too.
The things I am learning. Okay, let us go to more macro stuff, and we're looking at what happened here with the BOE. I'm looking at the 10-year gilt yield, pretty much flat, 4.14. The Bank of England sent its clearest signal yet. that it's closing in on interest rate cuts. And earlier, Bank of England Governor Andrew Bailey indicated the markets were underpricing the pace of easing in the months ahead. And Bailey made his comments after the UK central bank voted 7-2 to keep the base interest rate at 5.25%. Earlier, Andrew Bailey joined Bloomberg's Francine Lacroix to discuss today's decision, and he was first asked if the BOE may cut rates because it's worried the markets won't be prepared for what's to come.
Our forecasts are conditional on a number of things, but one of the things that obviously are conditional on is we use the market curve to set them up. So I think it's important that if we find that a forecast with the market curve produces a best judgment, which has inflation below target or above target, wherever, but not at target at the sort of horizon, we say so. We say this is where we got to. Best collective judgment is that. Now, it follows, I think, that, and this is the comment I made earlier, that what we're saying is if, and the if is of course critical here, if the world evolves as that forecast suggests it was, well, probably the case would be there for a less restrictive path of policy.
So is
it's
June,
all conditional.
Everything is conditional. Is June a live meeting?
All meetings are live.
So is June likely?
That's a different question. That's different. Look, I think the key points I would make is that we have changed our view on the likely persistence of inflation on the second round effects. And it's good news. We think there's evidence there to suggest they will be less pronounced than we thought they would be. But that's a judgment, and for me, I'm now looking at particularly these three key indicators: services inflation, pay, and the quantity side of the labour market, to really judge this persistence question, how it will evolve.
But Governor, because you were quite upfront about market expectations, does that come from Ben Bernanke's review that you will talk more about the markets to indicate more to the markets also what you're doing next?
Well, we're not going to implement the Bernanke review piecemeal. So we're obviously going to spend a few months really sort of thinking quite hard about what we do. And he raised the conditioning assumptions as a point actually, and this question which I think all central banks wrestle with in various ways, which is how do you actually sort of represent a future profile of rates to set up your judgment without sort of getting yourself into a position where you're absolutely nailed on, as it were, for a view of rates 2 years out, which of course is just not realistic to commit to.
But can we expect more market commentary from you going forward?
Well, I think we're in a particular situation at the moment. I've said before, it's a high bar, I think, for us to sort of come out and comment extensively. But I think the point we've made today, and I think have to make, is look, quite a lot of them, when we do the analysis, quite a lot of the market movement of late appears to have been US, in a sense, originated. Now, there's always some of that, of course, but there seems to be more of it. And yet, our analysis would be that inflation dynamics here are different to the inflation dynamics in the US. We're in a very different sort of situation in terms of our economies. So there's a tension in there, and I think that's the point we have to point out.
But this is basically because the Fed maybe overpromised the cuts in December and then couldn't deliver in terms of 2%.
Well, I'm not criticizing the Fed in any sense or judging the Fed. I think the US economy has evolved. I mean, that's the fact. I mean, that's how it's evolved. So I think the way it's evolved has been, if anything, to sort of put in a slightly starker relief the difference of inflation dynamics.
But Governor, are you worried about the second round effects of a cheaper pound?
Well, I mean, the exchange rate hasn't moved sharply, frankly. It's moved a bit, and of course you'd expect that because it's a relative price. So this point I make about different inflation dynamics, you'd expect some, but it hasn't moved sharply. So no, I'm not. We watch it very carefully, but it's not something that. And by the way, as we said, as we always do in setting up our commentary on the conditioning assumptions this time, actually the exchange rate hasn't moved that much.
That was Bank of England Governor Andrew Bailey alongside Francine Lacroix talking about the central bank decision today to do nothing, but definitely lay the groundwork for a cut later this year. I'm looking at the cable rate, so that's pound versus dollar, coming in at 1.25. So definitely getting some support there for the currency. Now I want to get you updated on all the news you need in the business world. Here is John Tucker. John?
All right, Alex, stocks to higher. S&P 500 has, in fact, crossed 5,200. It is technology that actually is one of the drags. NVIDIA shares, they are down 1.2%. Equinix shares jumping over 11%, reporting stronger profit in the latest quarter than analysts expected. The company, they run data centers around the world. They also said that an investigation internally by its board found no accounting problems. Robinhood Markets, they rose after breezing past analyst expectations for profit and revenue. It showed broad-based growth, in particular from customers trading cryptocurrencies. And then you had Airbnb, that is sinking, despite also topping expectations for profit and revenue. It gave a forecasted range for revenue in the current quarter. It was midpoint, did fall short of analyst expectations. S&P 500, 17 points higher. That's up 0.3%. We're at 52.05 on the index. Dow Jones Industrial Average up 179 points right now. That's up 0.5%. The NASDAQ 100, 40 points higher. That is up 0.2%. And as far as treasuries, the 2-year yield, 1 basis point lower. That's at 4.81. The 10-year is unchanged. That's at 4.48. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and
you got it. You can do it.
Molly.
Whew.
I'm thinking.
Usually
I'm
he
looking at
leads with Molly,
no, I was
and
thinking
then
about
Alex.
couch.
That's okay.
That
I
couch
also
on the
didn't
mind.
I call you like Paul? I called you something else the other day. So
You
I
call
think
me
we're
lots
fine.
of things.
I do. It's true.
Maybe it's because of that TV show I watched growing up called Molly and the Big Comfy Couch.
Wait, is that a TV show?
Oh my gosh, yeah, are you
Oh,
kidding?
yeah.
This was my anthem of the 90s.
I wasn't allowed to watch TV, guys. And we're just talking about this because
What kind of warped childhood did you have?
Sad.
whilst we were listening to Andrew Bailey, we were also looking at a video of Molly's new couch that's getting delivered today after much issue with the elevator size, and it's actually very cool.
Yeah, it has some functionality to it. I know, who thought we'd have a video of a couch that's, quote, very cool. But it's true. So the back of it, where you're leaning up against, it can go higher for like a higher neck rest. And then the seat pulls out for more leg room.
Yeah.
So
this
it's
is
got a
good. I
nice,
like this for
deep
you.
seat for you.
I also like the fact that you joined a pickleball league yesterday.
I did, yes. Our first game was last night. I know Jason Kelly is just ready here to jump on in. So yeah, it's a thing. Like, obviously I'm more of a tennis person for those of you who follow my brand, but I'm a fan of all the racket sports, so I don't discriminate. And I joined this league. I've been hoping to get back into it, but I gotta say the first night of competition was very underwhelming. So I am hoping that it gets a bit more competitive as we get into things.
Jason Kelly is cracking up a little bit. All right, speaking of, Jason Kelly is here.
Oh my God, this is amazing.
He's
Just
chief-
keep going.
He's
Just
chief
keep
correspondent. I'm
going.
trying to get your shot, man. The chief correspondent for Bloomberg Originals, executive producer of the podcast called The Deal with Alex Rodriguez and Jason Kelly. He's not part of a pickleball league?
Not yet.
But you're not really selling it, Molly, you got to be honest.
I'm just saying, I'm on the hunt, and it's obviously, I think one of your next guests has got to be somebody in the pickleball world.
We've talked pickleball.
Okay, so there's going to be more. Yeah.
There's more to come.
On this
For
week's
sure.
episode of The Deal, Alex Rodriguez and Jason Kelly spoke with sportscaster Stephen A. Smith about the difference between making money and knowing business. I love this. Here's what they had to say.
But I think for me, if I had to crystallize where business came to the forefront of my mind was when I got fired in 2009. You see, there's a difference between making money and learning business. When you're trying to make money, what you're doing is you're going out there, you're performing, you're praying that some sort of a meritocracy will be in existence. You'll be recognized for your attributes and your production, and ultimately you'll be fairly compensated for it. When you think about business, now you're looking at the entire landscape and you're monitoring what's transpiring, not just before your very eyes, but around you. And you're looking at the stratosphere that you're venturing into or that you're in the midst of. And you're paying attention to the tea leaves. You're paying attention to what's going on, et cetera, et cetera. Because when I got let go...
I got to say, based on those comments, I would put myself more in the making money or attempting to phase of life rather than this self-actualization of understanding business.
Yeah, I mean, listen, he went through some things to get to that point. Dude got fired from ESPN in 2009, as he talked about, and I mean, massive wake-up call. So do you need to get fired? Wait.
Yeah,
do we need to fire him? No.
Fingers in your ears. No one heard that. Rewind. But to be fair, it would definitely put the pedal to the metal.
Yeah.
You would definitely be more motivated if that was the case. But I don't want to be aware of that.
Let's not do that
whatsoever. What else did you guys talk about? What did you learn?
I mean, listen, this is a guy who revolutionized, easy for me to say, sports media. You know, I mean, and what's funny about Stephen A. is there's nobody who's like, yeah, he's okay. Like, there are people who love him, worship him, listen to him every day, listen to his podcast, watch his show, and there are people who will go on an expletive-laden rant against him and think he's ruined sports, and he knows that, and he almost leans into that idea. He will soon be, in some form or fashion, once again, the most highly paid sportscaster on the planet.
Amazing.
He's been there before, and he'll be back, and he is sort of building his own brand, not around pickleball, as you are.
Yeah, well, I mean, still tennis for the most part.
I know.
Just to keep it
I've seen
clear.
you at the Open.
Oh, thank you so much. Yeah.
I mean, not playing yet, but
she's working on
spectating. Yeah.
Correct, and calling, among other things. So tell us, what is, you know, how would you and how would Stephen A. define his brand right now?
I mean, I think it's a really good question, and I think what he has really zeroed in on is this idea of he wants to own what he does, and that's going to be a huge thing that comes as he renegotiates his contract, because Pat McAfee, who is one of the highest paid sportscasters now, also has a show on ESPN, but the key difference is he owns his show and licenses it to ESPN. That's not the case for Stephen A., but Stephen A. has built this podcast that he does own. So it'll be interesting to see. I think part of it is, or a big part of it, is really about control.
So it seems like then the licensing agreement, that's really more where the money's at.
Yes, exactly. I mean, owning your own content is I think something that he's really keen to do. And what's interesting too is that, you know, for all the talk about like he's all about takes and hot takes and yelling and all that, he is trained as a journalist. He knows his stuff in a really intense way. He was a columnist, a reporter, and ultimately a columnist for the Philadelphia Inquirer. And so when he has an opinion, it sometimes is quite bombastic, but he, you know, as the kids say, has the receipts.
He's an informed opinion. Like
Exactly.
It's one based in fact, not
Exactly.
just in
Like when
random
you start
speculation.
yelling about something on air, as you often do, like you've got the receipts too. I mean,
Only when it comes to oil. Like when I yell at you on oil, maybe I know some
That's
stuff.
your brand.
I've been on the other side of those.
Yeah.
I mean, it's intense.
It's intense. If I'm yelling at you about like, you know, software, I mean, I'm probably
or
making that
pickleball.
up.
Yeah,
definitely making
less
that up.
Less so.
What's his future? Like what?
I mean,
what's he gonna do?
so what's interesting is one of the things he says in his book, which is quite good, and we talked a lot about on this episode with him, is this idea of he loves sports, but he also loves politics. You know, he said presidential debates for him are like the Super Bowl. So
Really?
I think
when he could talk about an actual Super Bowl?
Yeah, right, exactly. And what's interesting is I think you could see him end up on hosting a late night show. I think he wants to widen the aperture. He loves talking about, as I alluded to, politics, but sort of culture and everything under the sun. So I think, you know, he's in his early to mid 50s. I think he's got a lot of runway ahead of him to, you know, really make his mark even beyond sports.
So would that kind of content fit into his current platform, or we're thinking like this would be a broader?
I think it'd be broader.
venture?
I mean, I think he'll keep doing the sports thing, but you know, his podcast, if you tune into it, is all over the place in terms of the guests that he brings on and the topics that he does. So I think he sees himself as having a much wider view of the world.
What else are you working on?
So we have one more episode for this season. It's going to be Mark Lowry, who is Alex's partner in the Minnesota Timberwolves, and obviously made all of his money as an entrepreneur. He sold Jet.com to Walmart. He created Diapers.com. You know,
Huge.
like who knew?
Yeah.
Sold that to Amazon. So he is, and now has this company called Wonder, which is a food service and food delivery company. But we talk a lot about not just his background as an entrepreneur, but their partnership in buying a big stake in the Minnesota Timberwolves, which is obviously in the headlines right now. They're doing quite well in the playoffs, so we get into a lot of that. And then that's the end of season 1. So going into production for the next season, so stay tuned.
How many more tennis stars are we getting in season 2? I mean, we had Serena and Sharapova in season 1.
I mean, that's pretty good.
That sets the bar high. I want to see Roger.
Yep. Well, tune in. That's one that's in the works, and Billie Jean obviously is on our list as well.
Our Lord and Savior,
yeah.
Billie Jean King. Yes.
Anyway,
wherever you are, Billie Jean.
But they're tennis people.
Yes.
Yeah.
Tennis.
No, I'm kidding. I knew that. I'm just messing with you. When Alex Rodriguez and Jason came in and they talked to us, I was like, look, disclaimer, I know nothing about sports, because when you fake it, you know,
but you knew Serena. You were excited about Serena.
I was so excited.
Yeah.
Like any woman that takes a brand and then makes it like a multi-million-dollar brand and just owns it.
And transcends. She transcended.
That's what I love.
And both of them at the Met Gala, too.
Looked
amazing.
Looked amazing. Yeah. Such a great point.
Venus, too. She was there.
Yeah.
Yes.
Yeah, I know. They are at another level for sure.
Red carpet ready, that's for sure.
All right, Jason, appreciate it. You can check
you.
out the latest episode dropping today. Jason Kelly, co-producer of The Deal. Let's get to news now with Michael Barr.
Daniels is back on the witness stand this morning in Donald Trump's criminal hush money trial. The former president accused of falsifying business records tied to buying off Stormy Daniels, the adult film actress, over an alleged sexual encounter. Trump spoke briefly to reporters on his way into the New York City courtroom.
No case. Should have never been brought. Alvin Bragg didn't want to bring it. Cy Vance didn't want to bring it, and he didn't. He left. He didn't bring it.
The defense is cross-examining Daniels on inconsistencies in her story. The U.S. has paused a shipment of bombs to Israel, and President Biden last night warned that more weapons could be held depending on Israel's military operations in Rafah. The IDF has already begun a series of targeted ground and air attacks in the southern Gaza City. President Biden issued a warning to Israel last night on CNN, saying the U.S. will withhold some weapons if Israel fully invades Rafah.
I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go into these population centers.
Meanwhile, President Biden told reporters no when asked if there was progress on ceasefire talks. Russia's President Vladimir Putin gave his Victory Day speech in Moscow. Russia will do it all and do what it can to avoid a clash of global powers, according to Putin, but still must be ready if one comes, Putin through an interpreter.
We won't allow anybody to threaten us, and we must always be on combat alert.
Victory Day marks the World War II defeat of Nazi Germany. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.